Got it. You tell me. 3, 2, 1, go. Kosh. Got it. Thank you. Hey, 早晨，大家好，你好，konnichiwa, annyeonghaseyo, salamat datang Hong Kong, bonjour et bienvenue, willkommen. Ladies and gentlemen, good morning and welcome. I am Andrew Work, and on behalf of the Hong Kong Monetary Authority, the Securities and Futures Commission, and the Hong Kong Academy of Finance, I'd like to welcome you to Part 2, if you will, of the Global Financial Leaders Investment Summit, something we like to call Conversations with Global Investors. We are here to talk investment. Why? Because economy-wide growth, jobs, and human thriving arise solely from investment. It is productive investment that allows individual inventors, entrepreneurs, workers, and institution builders to thrive. Now, malinvestment is the scourge that we all fight every day. Productive investment is the lofty goal that we aspire to uplift civilizations. Whether you are involved in the front action cut and thrust doing financial war, or whether you are involved in the more thoughtful business of think tanks, like the Hong Kong Academy of Finance, we are all trying to find a path through the fog of war. Today, we are going to clear away some of that fog by hearing from the greatest minds in investment from around the world here today at the Hong Kong Stock Exchange. Now, if you are in the fog of war, make no doubt about it, you are in a war. But even there are rules of war. And as you fight your financial battles, there are the rules of the marketplace, hopefully mostly observed. But Hong Kong's status as one of the world's great 3 financial centers, as Asia's financial anchor, arises in large part from the rules that we have here in Hong Kong. Those rules are created and enforced by the regulatory agencies of Hong Kong, including the Securities and Futures Commission. And so we are very excited today to welcome the chairman of the Securities and Futures Commission to launch our conversations with global investors. Please welcome the chairman of the SFC, Dr. Kelvin Wong.
The Honorable Mr. Paul Chan, Eddie, distinguished guests, ladies and gentlemen, good morning. Welcome to the Conversations with Global Investor Forum. This is the final event of the Financial Leaders Summit, but certainly not the least. Today marks our 4th edition since the pandemic. Amid all evolving global challenges, Hong Kong stands strong and resilient as an international financial center. The theme this year is tracking through shifting terrain. Despite the global change, the collective wisdoms of top investment leaders in this hall is vital for us to stand afoot in today's seismic transformation. Your expertise across macro, technology, alternative assets, and more is vital for us to navigate today's complexity and chart our way forward. On one hand, markets now demand caution. Geoeconomic fragmentation, rising debt, technological disruption, and concentration risks all put pressure to our resilience. On the other hand, opportunities persist. As the saying goes, nothing ventured, nothing gained. Diversification matters more than ever. Spreading our risk across regions and asset classes delivers stability and performance. This strategy remains robust even in uncertain times. Amid this wave of global diversification, Asian markets shine as an anchor and stay resilient, providing growth certainty and effective hedges for investors. Similarly, IMF recently expects Asia to be the best and the biggest driver for global economic growth this year and next. In Hong Kong, we are making sure our capital markets set the standards for Asian excellence. As capital market regulator, the SFC remains committed to one clear mission: defend and enhance Hong Kong's status as a leading international financial center. We are steadfast in implementing effective regulation through our dual mandates of maintaining integrity and fostering development. It is also our essential duty to enhance Hong Kong's market performance and wealth creation capabilities. As we work together with other regulators, including the Hong Kong MA, to protect investors and build global trust. This year, progress has been strong, especially in asset and wealth management. We support growth through a richer product landscape and greater fund market connectivity. We champion innovation through tokenization and digital assets. We also uphold integrity and trust through an unwavering commitment to international standards. Most importantly, collaboration with global stakeholders makes our mission and achievements possible. This year, global investors have shown renewed confidence in Hong Kong, especially as the leading gateway to China. Those who waited before are now returning and are ready to share the vast dividends of the Greater China markets. As Asia's #1 financial center, the city continues to top the global IPO league table. This year, we completed some of the world's largest IPOs, attracting top sovereign funds and institutional investors. Funds raised have more than tripled year on year, a testament to the efficiency of our premier listing platform. As a vibrant asset and wealth management hub, the city's AUM has doubled over a decade, with Hong Kong's domiciled funds growing even more strongly. This showcases the opportunities from our unparalleled mainland market access. Therefore, you can have full confidence in Hong Kong's world-class financial sector and regulatory frameworks. We will build on this strong momentum and unlock even more new opportunities for global investors. Finally, I would like to encourage all of you to make the best use of your time here. This means not just staying in the meeting room today in Central, but also getting on to the streets to experience the glamour of the local cities and scene. Now let us begin our productive discussions today to shape our strategies for tomorrow. Thank you.
Thank you very much, Dr. Wong. All right. And what a great way to start. It was just 2 years ago that I was up here on this stage at the Global Financial Leaders Investment Summit when I welcomed to the stage Paul Chan, fresh back from Saudi Arabia, shaking the sand out of his shoes. And so it is again. He is just back from Riyadh, where he has been out there continuing to build bridges for Hong Kong. He continues to do that every day, building bridges for our city, guiding Hong Kong back into the black and providing leadership and stewardship of our official financial institutions. And he has been doing this for 8.5 years now. Very impressive. He is also the honorary chairman of the Hong Kong Academy of Finance. He's always ready with a handshake, a smile, and the sharpest numbers in the room. Please welcome Paul Chan, the Financial Secretary of the Hong Kong Special Administrative Region of the People's Republic of China.
Thank you for the kind words. Kevin, Eddie, Julia, distinguished guests, ladies and gentlemen, good morning. It is a pleasure to join you again. Today's discussion centers on identifying new growth engines across geographic sectors and technologies. In that spirit, allow me to share a few observations which I believe are factors shaping the investment landscape and why Hong Kong is where you want to invest in. Let me begin with the transformative power of artificial intelligence and digitalization. I understand that you have heard a lot about it over the past 2 days, but it is no exaggeration to say that AI has indeed become the defining keyword of our era. From boardrooms to classrooms, logistic hubs to laboratories, AI is shaping the way we live, work, play, and communicate. According to the World Trade Organization, up to half of global trade growth, this year, is estimated to be driven by AI-related expenditure. Global private investment in AI has already exceeded $190 billion this year alone. But these figures reflect more than just enthusiasm. They signal a structural shift. AI is no longer confined to a single sector. It is a powerful enabler across sectors: finance, logistics, healthcare, smart manufacturing, and beyond. China recognizes the strategic value of AI. In the recommendation on the 15th five-year plan laid out by the fourth plenary of the CPC Central Committee, AI plays a central role in advancing digital China. They call for accelerated breakthroughs in foundational, they call for accelerated breakthroughs in foundational theories and core technologies, robust supply of computing power, algorithm, and data, and comprehensive application of AI plus across sectors, industries, culture, and societal governance. Here in Hong Kong, we share a similar vision, which is to be realized by a twin engine strategy, developing AI as a core industry and promoting AI as an enabler to upgrade traditional sectors. Our strategy rests on 6 pillars: computing power, algorithm, application scenarios, data, capital, and talent. And we are well positioned. 3 of our universities are ranked among the global top 20 in AI and data science. As NVIDIA CEO Jensen Huang noted, some 50% of global AI researchers are Chinese. Amid geopolitical tension, an increasing number of these researchers are coming here, using Hong Kong as their base for academic research and application of research outcomes. He also remarked that the Greater Bay Area was the only region in the world mechatronics technology and AI technology simultaneously reside. Indeed, with strong advanced manufacturing capabilities, the GBA is a region where AI can be directly and seamlessly applied, tested, and validated in real-world industrial settings. Hong Kong is making great strides in building a vibrant and globally connected AI ecosystem. A key element of this effort is attracting leading enterprises in the field to Hong Kong. To this end, we have rolled out different initiatives supported by dedicated incentive schemes and funding. We are also investing directly and co-investing with others in AI companies, startups, and projects. Through the Hong Kong Investment Corporation, we magnify our leverage by channeling more private capital to this sector. Talent is indispensable if we are to succeed in AI. We have therefore modified our talent admission schemes accordingly and launched such initiatives as AI Talent Global Connect to bring together top AI talent from around the world in Hong Kong and help establish a network of young AI talent here to facilitate their collaboration and synergistic growth and development. The second observation is about sustainability. For the world at large, despite the United States' withdrawal from climate commitments, the momentum for net zero transition elsewhere remains strong, particularly in China, which is expected to invest nearly $820 billion in energy transition this year, accounting for around 40% of the global total. Hong Kong is actively contributing to the regional green transition. We are Asia's leader in green and sustainable finance. In 2024, over $80 billion in green and sustainable debts was arranged in Hong Kong. There is a diverse range of issuers, including local and overseas business enterprises, multilateral organizations like development banks, and mainland, provincial, and municipal governments. As an international financial center, Hong Kong is deploying innovative financial instruments to address the diverse financing needs of emerging economies. Catastrophe bonds, for example, are valuable risk transfer instruments for countries vulnerable to natural disasters. Since 2021, 7 cat bonds have been issued in Hong Kong, totaling $800 million, supporting countries across Asia, the Americas, and Africa in helping them fighting the risk of typhoon and earthquakes. Another example, of course, is insurance-linked securities. But let me go to my third observation, which is this. Financial services are key enablers of innovative activities in the economy. We need to be innovative with a ready-to-reform mindset to capture the opportunities arising from changing economic fundamentals. In Hong Kong, we always embrace change. A prime example is the ongoing reform of our listing regime. Since 2018, we introduced a series of measures to facilitate more new economy companies to list on our stock exchange, including those with weighted voting rights structures and pre-revenue or pre-profit biotech firms. In 2023, we introduced new arrangements to facilitate pre-commercial specialist technology companies to get listed on our stock exchange. As a result of this spirit of reform and innovation, the share of new economy companies in our market has more than doubled, growing from 16% of total market cap in 2017 to 35% today. In terms of IPO proceeds, they account for 45% of funds raised from 2018 to the first half of 2025. Indeed, we see substantial room for growth in our capital markets. The positive outlook of China's development and technological advancement supports this optimism. At present, the combined market cap of Hong Kong, Shanghai, and Shenzhen stock exchanges stands at approximately 100% of China's GDP. In contrast, the corresponding figures for stock exchanges in the United States is over 200. Ladies and gentlemen, the above three observations, AI, sustainability, and innovation in finance, demonstrate the agility, creativity, and innovative spirit of Hong Kong in navigating changing dynamics in the global and regional economic landscape. That is why Hong Kong offers tremendous growth opportunities. We are connecting capital with ideas, innovation with applications, and investors with new opportunities across Asia and beyond. With the staunch support of the central authorities, our unique advantages under the one country, two systems framework, our world-class institutions, and most importantly, talent, pro-business, pro-innovation government policies, and our unwavering commitment to excellence, I'm confident that Hong Kong will continue to shine as a premier international financial center, a place that creates boundless opportunities for global investors. Thank you very much.
Great job. Great to see you. And thank you very much to the Financial Secretary for joining us here today at the Global Financial Leaders Investment Summit. We are looking ahead, and there are choppy waters out there, making it very difficult to look ahead and determine what is going to be the new trade and investment landscape particularly after the very chaotic 10 months that we have had on the world stage. Long-term vision, a long-term strategy becomes a perilous business in these kinds of conditions, but we all have to do it. We are fortunate today that we have our next panel coming up, the first of our conversations, if you will, to look ahead, to bring us some of their vision, some of their long-term strategy, so we can determine a path forward in the new economic order. Leading the panel today is going to be Dr. Eric Yip, the Executive Director for Intermediaries with the Securities and Futures Commission from right here in Hong Kong. Jean Hines is the CEO and Managing Partner at Wellington Management. She's going to be joined by Eric Schlossberg, who is the President and CEO for Invesco. Also joining them is Eric Stein, the Chief Investment Officer with Voya Investment Management. And rounding it all out will be Hendrik Duchois, who is the founder and CEO with 91. And with that, Dr. Yip, the floor is yours. Please, let's welcome them.
Can you hear me? Yes. This is a great day here, and I don't need to do the introduction because we have all of our panelists, distinguished panelists, introduced. The one thing that I want to supplement is that they are all from my favorite cities. We just talk about that. So we have Jean and Eric, also a very good name, from Boston. And then Andrew, also from my favorite city, because in Atlanta, my favorite football team, New England Patriots, came back from the biggest comeback in all time in 2017, beating the Atlanta Falcons. And Hendrik, I didn't tell you that my best friend is actually from South Africa. So you guys are cool. Yeah. So, and my boss is downstairs, and also my whole board is downstairs. But Julia said that I'm supposed to be entertaining, but I'm not. I'm regulated now. So we are talking about very serious stuff, new economic order. And I try to set the stage to talk about geo-economic fragmentation. Just quote some figures. According to a WTO report, there has been like 1,300 of trade barriers being introduced since 2019 and 2023. That's a significant increase from previous years. That result in about 12% drop in foreign investment, 12% drop in the trading blocks between China and US. A lot of the multinationals are thinking about reshoring. Now, if you talk about trade barriers, to me, it's more a result. If you look at the cost and consequence analysis, that's more the consequence, the results. I want to start first exploring what are the reasons for trade barriers. And then if you have to predict, is it going to get worse, better, or more or less the same? Why don't we start with Eugene?
So I think the part of the reasons for the trade barriers, if I have to take a big step back, if I go back to earlier this year when President Trump of the United States announced the tariffs, I would say it was done in maybe an imprecise way, but there are probably some reasons behind. If you take a step back and what is he trying to solve for? There's over time things happen that create anomalies, and I think probably in Europe it was defense, right? Defense was one of them. I've been a healthcare investor for over 35 years, and one of the anomalies as well has been how the U.S. funds almost all of the research. It's starting to happen in this area as well. I'm very excited about the future of biotech in China and Hong Kong. It's super exciting. But right now, the U.S. and the U.S. population actually funds, through drug pricing in the U.S., funds all the research now that happens in bringing new medicines to the world. And so that's an anomaly, right? So you have these anomalies that have existed. And so part of the blunt instrument of the tariffs is trying to solve for that, but it's trying to solve for it in a very blunt way. But I think those are some of the things that are behind some of the moves that we've seen this year.
So Andrew, down from Atlanta, you think this is going to get better, worse, or pretty much the same?
Well, first, thank you for having me again here. Thank you to the HKMA. I'm going to take the less popular position on this and say we'll look back in 10 years and fragmentation will be better, and we'll look back and we'll see a connected global economy, connected global markets. I just don't think we can go backwards. And I think innovation, technology, and frankly, the consumer is what's going to drive it.
All right. So, Eric, your view?
Yeah, I would say, to me, two main points. Just the concept of tariffs, and this was a big takeaway I had when I was down at the IMF meetings in Washington last month, is here to stay from a U.S. perspective, unless we get a massive sea change of a traditional center-right or center-left party back, and I don't see that right now. So tariffs, I don't like them. I'm a free market person at heart. I'm in Hong Kong. Thank you again for having me in the kind of the center of free markets. But tariffs are here to stay from a U.S. policy perspective. I think it's going to outlast the current administration. So I'd say that's number one. And then number two, maybe I'll disagree with Andrew, is really this U.S.-China fissure, to me, is structural. There can be cyclical up and downs. Now seems better post the meeting with Trump and Xi, but I think there is a structural fissure. I still think we're in an era of globalization. We're not deglobalization, but I'll say we're in re-globalization with these two distinct economic blocks, and then some countries that are more unaffiliated, maybe in a third block.
All right. Thank you, Eric. And Hendrik, you have the last say.
So, my name's not Eric on the panel, and I wasn't called Eric by the first speaker, so I'm all right. And I can therefore be slightly different. I grew up in an emerging market. I grew up in a world where the West preached a certain orthodoxy until they got competed out of existence, and then they changed the rules. That's what's happening here. And it's driven by domestic politics. It's driven by weaker, by issues at home, and therefore not global issues. And therefore we're going to have a different globalization, but we're all going to understand that nations are driven by their own interests and their own domestic interests rather than this idea of a fair global order for all imposed by a benign hegemon. So that means you've got to understand what happens inside each region, each country when you invest, because that's going to drive the policy logic. I don't believe we're going to have a continuation of Chimerica, but globalization has always been with us, will always be. People have traded with, if you just go to the Middle East where I was last week, you just know that Arab traders have traded with Africa for thousands of, more than 1,000 years. That's not going to change. And therefore, we just have a more nuanced, more subtle world, and we need to do a great deal as investors, more bottom-up work, because that simple model we had, interest rates fall after Volcker forever, inflation is under control, there's one sort of simple, there's a dominant currency which isn't going to have cycles of weakness, which was we've come out of a 23-year dollar positive or dollar cycle, of which the last, I think it's 14 years have been positive. That's also going to change. So a really interesting world ahead, but thank you for having us here. I really appreciate being here.
Thank you, Hendrik. I like the fact that it seems like the panelists have different views. That means that one of you will be correct in the future. So, and indeed, we are trying to answer questions that may not have a simple answers. And the fact is that we are living in a very confusing world. Now, while we talk about geoeconomic fragmentation, the confusing part to me is that I also see that the world we are living in seems to be more connected, seems to be more borderless. Look at consumers. Consumers now are spoiled. I mean, they are very digital savvy. They can shop around. They can always bargain for the best deal. My wife has been recently addicted to PDD. So I just introduced that to Jean. I mean, she has not heard of it. And then I know her behavior because she is using my WeChat Pay. So I can see every day, basically. In a period of 30 seconds, I see payment of $5, Hong Kong dollar, renminbi, $15, $20, $30. And I said, that's fine, that's not a lot of money. But a few days later, I see stacks of goods appear on my doorstep. And in Hong Kong, our apartment, we are living in an apartment, which is quite small. So I now need to find a place to store those PDD goods. And that becomes a very expensive problem. So that's how consumers have been. So, I mean, people blame inflation here and there, but they are actually buying things like dirt cheap, like globally. And on the other side, I used to be in private equity and banking. I saw corporates being destroyed by this globalization and this kind of new order. The business model evaporated, and then the newcomers coming in. Well, I think this become a very, very complex supply chain environment. So I will start with you, Andrew, because you have heard of PDD and multi.
Yeah.
So what's happening to consumers, producers, and distributors? And since you guys are all from the buy side, you look at the companies, talk to corporate executives, what are they worried about, and what are you looking for?
Yeah, it's an important question, and I think everybody will want to share, so I'll try to be brief. I think if you think about the consumer, and I'll start in the US, the fear of inflation, which we haven't fully seen, is top of mind. And the consumer, there's many kinds of consumers in America, but there's at least two kinds, and they're pretty bifurcated. So if you owned your home and you were invested in the stock market over the last 5 years, you have a lot of purchasing power, and you'll be able to withstand maybe some of the inflation that's in the system. If you're the other side of that, the economy is struggling a bit. And I think that's where the Fed is really trying to sort through what's going on there. So the consumer behavior is quite different there. And then when you look at China, all the discussion, at least I was picking up, is around the fear of deflation. So we've got these sort of polars that are going on around the markets. When we speak to corporations, one of the things that's on their minds is looking through all of this volatility, looking through all this uncertainty, whether there's trade barriers extending, whether we're going to re-globalize or de-globalize. And long-term commitments of investments are relatively anemic. And then if you look at the investor, especially the individual investor, there is a lot of cash still on the sidelines. So I think I'd say watch inflation or deflation, and there goes the consumer.
So what's your view, Eric? I mean, inflation, deflation, which factor is going to override the other? And I think also important is that when you look at the different sectors, are there particular sectors that are being more affected, or there are more opportunities?
Yeah, so no, great question. Just maybe to build on a little what Andrew said, there is a regional difference. So in China, to me, just as someone who traded Chinese bonds maybe 10 years ago, Chinese bonds with a one handle is very different from where they were, particularly given the rate sell-off we saw globally in 2022, which we've come off the highs in most developed bond markets with movements around. And so that's just showing me in China from a market indicator perspective with CGBs in the mid ones that it's a deflation challenge, not an inflation challenge. From a U.S. perspective, if you go back 3 years, if you go back to 2022, it was the first time probably in 40 years that inflation was a big political issue. It largely drove, I think, the 22 midterms. It had significant effects in the 2024 presidential election, and we're not fully out of that. We're somewhat out of it from what a bond geek would look at, year-over-year inflation that drives the treasury market. But to me, from a political economy perspective, it's what people pay for basic goods and services, particularly food, energy, shelter, things of that nature. And the price level has come up, even if the rate of change has slowed. So that has both political effects and, to Andrew's points, has economic effects, because those typically are not the consumers that have had the house price and asset market inflation. So that's on the consumer side. And then from a corporate perspective, to me, the most interesting thing really is the supply chain, something you heard almost nothing about until COVID. COVID really got companies and particularly investors focused on all the supply chain issues. And then even now with the tariffs and the back and forth between the US and China, corporate executives that are manufacturing from a global supply chain are more focused on it. I think we're getting, again, from this economic fragmentation perspective, somewhat more fragmented supply chains.
All right, so I know Jean and Andrew, you're heading to Tokyo. Is it after, are you also, Eric, going to Tokyo? No, Andrew, not going to Tokyo. But in Tokyo, you kind of see a bit of that. You're probably going to pay outrageous price for your hotel. But then you look at the food, the consumer goods, they're cheap. So that's actually also, even within a single economy, you see a bit of both sides. And that's kind of, you see the property and the non-property sectors behaving differently. And whether you're owner or not owner, that actually affects a big time on your behavior. Hendrik, you are the entrepreneur on the stage. Really, I also observe a lot of new entrepreneurship in the world, because there's a lot of disruptions going on because of the new order. If you look at companies, if you look at sectors, how will you analyze from an entrepreneurial point of view?
I mean, some marketing guy, and I still have to give him credit, but when he invented the sort of strapline, investing for a world of change, I thought that was great when he came up with it. And I realized how difficult it is, how fast change is, how the world is accelerating. And it's not just AI. We spoke a lot about that yesterday. Quantum's coming after that. The way we do things will change fundamentally, and that's what I really enjoy when I come to China and I see the creative kind of entrepreneurial part or fintech part of it, and I'm very fortunate to have been on the board of a very large investor, the largest in Tencent for many years, and I sort of view it from that point of view. So for me, if you invest in businesses, you've got to invest in businesses where management have that entrepreneurial streak, that they can move fast enough with the times. Backward-looking institutionalism, which is essentially plaguing our industry, is something which is going to be, you're going to pay a heavy price for that. So I'm very excited, and what I'm really excited about, if we were sitting here, I was thinking about it this morning, if we sat here 50 years ago, when Larry Fink started in finance, this would have been a colony. It was largely British audience talking about British companies dominating the area, trading with China. 50 years, if we were here over 60 years ago in the Middle East, Abu Dhabi would have, in fact, in 1961, Abu Dhabi had one building. One. Go look at it today. So the talent that is coming from what I call the rest of the world, the 7 billion, not the 1 billion, is enormous. And if we can find that entrepreneurial talent, and a lot of it's right here, being encouraged by this kind of environment, and if you go north of the border, you see it live, you see it happening in front of you, so we have more choice. That's I would say. I would say the opportunity today is more choice to back more entrepreneurs in more places and get the diversity in your portfolio that you probably lacked in a world which is dominated by a single economy or a single economic system. That to me is what excites me about tomorrow.
So Hendrik, you're absolutely right. I spent the last 15 years in China before I joined the commission. I gave up because, there's a term, used to have a term called 996. That means you work 9 to 9 for 6 days. That's no longer the case. The new term is 007. So, and it's actually true. The scary part is that. So if you, after your multi-fist, you go back to your office, you will see your boss, which is the entrepreneur, still working. So that's actually how competitive, scary, and how hardworking entrepreneurs are. Jane, you have a very impressive career. I did my homework in the sense that, you actually grew up in Wellington as an administrative assistant, and then you grew into research. Am I right? So,
Right.
And in your research mind, how do you make sense out of this economic order when I talk about like the consumers, distributors, and producers, and the fact that I think disrupting companies here and there? How do you research that kind of dynamics?
So I did grow up as a researcher. So one of the interesting things is sometimes I'm on panels and people want me to talk about the macro, and I always go to the micro. So I always go to the micro because that's where I spent the last 35 years, at the micro. And I obviously did that in biotech and pharmaceuticals. And at Wellington, we do it on the micro level across all sectors. So I'll make one comment about the consumer and then bring it back to corporates. In the last month, I've had the opportunity to just interact with CEOs that interact with all the consumers in the US. And what they're seeing is that in some ways nothing has changed. There's like 3 or 4% growth of the consumers, and this is companies like Visa and Bank of America. They have such a great window into the US consumer, but at the same time they're changing behaviors, right? Because clearly if I read notes or I listen to our morning meeting, restaurants are quite weak. So there's some change in behavior that's happening. And so that's what we do then, right? So that's what we do. We try to figure out there's that macro spend, and then where is that spend going? And that just means interacting with all the corporations across the globe in this region and in Europe and in the US to try to figure out and build the mosaic of where that spending is going and where there's change happening. And that's what that's what we do for a living. That's what I've done for 35 years, and I think it's a particularly interesting time when you combine tariffs. I'll tell it one quick story. I was with a number of CEOs across all industries in April, and I was on a panel like this. And it was, it was very gloomy at the beginning of the day, talking about the impact of tariffs. And then when I was on the panel, people started smiling, and I'm like, wow, they are very interested in what I have to say. And then towards the end of the panel, the audience announced to the speakers that the tariffs had been lifted temporarily. And so I wanted to share this enormous relief that went across the faces of 50 CEOs. And so, within minutes, within minutes. And so now it's time, so you have the tariffs, you have AI, there's just enormous change. I feel it as a CEO myself. There's just enormous headwinds, tailwinds that are coming for corporations to help navigate that will change the earnings picture. Ultimately, it comes down to earnings. It will change the earnings picture of the world in the next, 10 to 20 years. And so that's where deep individual research will really come in to try to differentiate where the world is going and who's going to benefit. And I think it's going to be a super exciting time for us as researchers.
Well, very interesting. I was actually in Cadiz, Spain, on Liberation Day. So I was surrounded by blue sky and white beaches. And it was very chaotic, but then I didn't receive any phone call from my colleagues. And the day that I come back, everything seems to be normal. So we can research on a lot of events, but it seems like events take care of itself as well. So we need to kind of maintain a certain coolness, not to be hyped up by the noises. And then I want to switch to a topic that is very hype. We have 7 minutes left. I promise the panelists I will leave at least 3-4 minutes on the last part because every one of us want to hear their investment advice. But I want to talk about one more topic, which is AI. So AI is so hyped up in a sense that everyone has their own opinion. I want to make it more interesting because I want to put my best on the table first. I would review my view on AI. I believe in mean reversion. I grew up in securities market. I grew up in investment market. I believe in mean reversion. I believe in economics, bottom-up researchers. I don't believe in hype. And I really, when I come to AI, to me, I believe in AI, but I think most ventures at the end of the day will fail. Just like what IMF has weighed in recently, saying that this is very much like the dot-com bubble. Now, my question, we only have 2-3 minutes to talk about this. Is AI overhyped, or is AI Taylor Swift, which means they stay hot forever? Andre, you're the entrepreneur.
It's absolutely not overhyped. Maybe the markets are overhyping some AI stocks. That's different from saying the impact of AI is over. This is a change which is going to be massive and has only started.
That's great. Eric?
Taylor Swift, full stop.
All right.
Wow. And as a father of a teenage daughter, she'll be proud that I brought up Taylor Swift on a panel.
To be honest, for the record, I was bearish on Taylor Swift when she was out. I don't like her music, so I was wrong. Yes. Okay. Yes. Andrew?
I've been to a Taylor Swift concert, and I can definitely say it's transformative and it's not overhyped, and I'll say the same for this. The only thing I'll say is, with any major innovation, change, and any transformation, there are going to be misses, and there are going to be places where it might get overhyped, and I just think that's a feature of innovation, not a bug.
All right, Jean, you have 4 daughters.
4 daughters who
grew
up with Taylor Swift, and I went all over the world to bring them to the Eras Tour. Went 3 times.
Right, yeah. And you enjoy it?
I'm a Swiftie. Become a Swiftie. I was a driver in the front of the car for 15 years, and then now I'm a Swiftie.
All right. So AI, is it Taylor Swift or not?
AI is definitely Taylor Swift.
So Taylor Swift. So 4 against 1 So in the sense that I have been proven wrong in Taylor Swift, I probably will be proven wrong in AI. Just because I think at the end of the day, I do believe in technology, I believe in AI. It's just that also I'm very scary when people kind of get excited just by the mentioning of the term AI and Gen AI. So that is something that we try to avoid.
Couldn't agree with you more. Yes. Yeah.
So there are still some pretenders, some kind of for real. Yeah, last, we have 4 minutes, 1 minute each. Investment advice, and that's, again, in our pre-meeting, our panelists is very sensitive in the sense that because I'm a regulator, they're not going to talk about things that have conflict of interest. But I mean, I'm testing your also compliance culture and compliance mindset. So Eric, start with you. You are the new CIO.
Yeah, we have a strong compliance culture at Voya. So advice, maybe just some opinions on markets. And I really liked what Mike Gitlin said yesterday, more focused on 2036 than 2026. But I'll start with 2026. Even though I think AI is Taylor Swift, I'd actually buy the S&P 493, kind of X the Mag 7 on a 1-year view. But on a 10-year view, I think things that the world is short, compute and energy, are really good places to invest. And then to bring it back to the panel of economic fragmentation, I think the dollar still has a lot of reasons to exist and be strong and be used. But at the margin, we are in a world of de-dollarization, of more hedging of dollar assets in this and other parts of the world. So I think we're likely in for a weaker dollar, similar to what we've seen this year.
Andrew, Investco's view.
Yeah, I'm going to go caveat with all the compliance. I'm going to go with basically 2 simple principles that we were all taught at the beginning of our careers and maybe sooner will feature in 26, and that's be heavily diversified and keep some dry powder for many of the reasons that you just said. The narrowness of the markets over the last several years means that there's going to be a broadening out where rates are potentially going or likely going. EM, smaller cap, mid cap are all places where I think people have been underinvested and they're going to catch up. And then in terms of keeping the powder dry, I think there is some point where we're probably closer to a correction than we are to 10%, 20% up from here. There will be opportunities to work your capital, so have enough liquidity.
Jane.
So I 100% agree with the 493, and I don't think it's just a 1 year. I think it is probably multiple years, and that doesn't mean that I thought the energy panel yesterday was probably one of the most fascinating, where I learned the most, and so clearly the amount of energy needed and the ability for those companies to make money will still be strong. But I think what's missing in all the analysis is how AI is going to impact this is not the internet. AI, I love the analogy of its electricity. It's going to impact every single company in the world, and those companies are trading at much lower multiples than those 7 stocks. And so I think how every company benefits from innovation with AI, efficiency, will, I think, bolster the PE and the earnings of companies around the world in ways that we probably don't realize yet. And so being more active, and I know I'm talking our book, but I do think being more active, being more diversified is probably the way to go in the next multiple years.
I'm going to be unashamedly talking my book. It's diversification from the dominant market today, a new dollar cycle, which I'm not thinking the dollar is going to disappear, but there is a dollar down cycle starting. There's a massive asset diversification away from the US starting, going into smaller markets. There's an entrepreneurial boom in Asia, particularly in China, which we need to get. And then, of course, energy. I don't know how to access it at the right price, but it's a hell of a lot cheaper than AI. And then finally, really being short on governments. So in other words, the world lived off government debt for a long time. Back the private sector in this complicated world and you'll win.
Okay, I still have 14 seconds. I'm going to steal 30 seconds from the audience. In 3 seconds, tell me what you like about Hong Kong, Jean.
I love the dynamism. It's just an energy.
Energy. Andrew.
I like seeing a lot of young people back out and about in Hong Kong.
Eric.
Free markets and Lang Kwai Fong.
All right.
Free markets, food, and fun.
All right. So we should give a round of applause to our distinguished panelists. Thank you very much. Thank you very much.
Thank you to our panelists and thank you to our moderator. If we could have you for a photo right up in front. And this is a double tap photo. You've got to look to our official photographer first up. And after he has gotten his shot off, you need to look to the back to the RTHK booth for a long shot, if you will. Marvelous job by our moderator, Dr. Eric Yip. Eric, way to go. Set a high bar for moderators today. Fantastic. And as the founder of a free market think tank, I love hearing the plug for the free market, so thank you very much. Wonderful job by our panel today. Thank you. Great job, Eric. All right, thank you. All right, now within the world of investment, we have the world of asset management. And asset management is being roiled now. It's being roiled by advances in fintech, by the changes wrought by artificial intelligence, and by public pressure to adopt more sustainable practices. So we must adapt, we must change, but how will we change? That is what our next panel is getting into. They are going to be led by Harshika Patel, who is the Chief Executive Officer of Asia Private Bank with JP Morgan. She's going to be speaking here on stage with Katie Koch, who is the CEO of TCW. Also joining them on stage is Richard Oldfield, who is the Group Chief Executive with Schroders. Tobias C. Pross is the CEO at Alliance Global Investors, and rounding it all out from Switzerland is Laurent Ramsey, who is the managing partner with the Pictet Group. And with that, Harshika, the floor is yours. Take it away, please.
Right, well, good morning, everybody. Thank you to Eddie, Team HKMA, and Julian team for an absolutely wonderful few days. Do brace yourself for the next 30 minutes because we really do have a high-octane discussion ahead of us on the future of asset management. My guests really need no introduction. Between them, their companies manage over $2.5 trillion of assets. Their companies have over 6 centuries of history, so I'm really looking forward to their insights. Now, because Eric did such a marvelous job of moderating, I feel that I have to trump him somehow. So with that, I took the liberty of having a bit of fun with the CVs of our esteemed panelists and Grok. And by the way, they don't know this is coming. And so I said to Grok, if you have to look, please describe each of these panelists as a financial asset class. Okay. So this is what I got. So Katie, ladies first. Growth equity with a defensive tilt. You thrive in volatility as evidenced by your steering of TCW and Goldman Sachs through rate cycles and mixed market signals. Richard, you're more of an investment-grade bond, corporate bond. Your rapid ascent from CFO to CEO in under a year signals adaptability, while your roots as a chartered accountant provide a moat against volatility. Okay, Tobias, you're more of a large-cap growth equity. You thrive on equity upside, championing where value creation happens, but are buffered by Allianz's balance sheet and safeguards against volatility. And finally, Laurent, you are the perpetual preferred stock. Your cumulative dividends ensure consistency, and of course, you're not the biggest, but the best mantra. Ladies and gentlemen, a big round of applause for our panelists. All right, so now that we've had a bit of the fun stuff, why don't we dive into the more serious stuff? And perhaps, Richard, I'll start with you. So in 3 days' time, you'll be celebrating your 1-year anniversary as the CEO of one of the oldest financial institutions in the UK.
So the key point there, Harshika, is Mr. Trump and I have our first anniversary within a couple of days of each other. That's the only resemblance, by the way. But
So, Richard, you set yourself the objective of meeting 100 clients in the first 100 days when you took on this job. What did you hear in those conversations? In particular, what are clients of the future wanting from, the asset management industry going forwards?
Well, it's interesting. I mean, we're very privileged. We serve clients in both the wealth channel and the institutional channel, and of course, therefore, the response differs slightly. I've seen clients now across 28 of the 38 countries that we've been in. Again, you get a bit of a regional flavor. But I think there's three common themes. One is, how do you help us navigate complexity? And I was reflecting last night, we spent a lot of time yesterday talking about AI, and it's super important. But actually, our clients are really talking about, we've got a long-term shift in government fiscal positions. We have a shift because of geopolitics. So technology, and I broaden it out past AI, is one piece of all of the changes that they are facing and thinking about. And the word that clearly came out of the last panel was diversification. So everyone wants to have diversification. But I think many people are also stuck with FOMO, because actually, if you diversify too early, you've missed out on quite a lot of returns from the concentrated markets that we're in today. So what they're asking for is, help us think about shifts in portfolio construction that you've got to do over 18, 24 months. You can't do that really quickly. And how do you help us navigate that shift between the public and private markets? And we forget as an industry, we've done this a lot. You know, whether that was through the financial crisis, the dot-com bubble, the Asian crisis. I'm that old, I can remember the Latin American debt crisis. You know, for many of our institutions have gone back and thought about wars. We have, as institutions, navigated people's wealth through uncertainty and crises, and I think that's the thing people have been looking for. The second big theme for me is really about asset management is no different to any other industry. So can we have more for less? More insight, more support, and by the way, can your fees come down? And I don't think that's any different to any other industry. And the third thing that probably reflects more of Schroders than anything else is sustainability is still important. So don't give up on it. And we've embedded sustainability because we think it's a really key input into investment choices, because it's about opportunities, it's about risks, no different to actually how we think about technology change. So a very clear message for us has been, don't give up on that.
Great, thank you very much. So Katie, almost taking what Richard said slightly forward in terms of looking after your clients for the long term amidst all of this instability and volatility that the world's seeing. You started TCW a couple of years ago, and when the actual founder, Robert Day, passed not so long ago, he left you with a very powerful message. He said, remember, Katie, you're in the investment business, allow it to compound over time. So what exactly did he mean by that, and how are you trying to preserve that philosophy at TCW? And one thing that many of you may not know is TCW is actually owned by the employees. 44% of the company is owned by the employees. So how do you preserve that philosophy?
Yeah, and what did he mean by it? I think what he was trying to tell me was this: you got a good thing going here, kid, don't mess it up, I think is actually what he was trying to say. But our industry is, and there's a little bit of wisdom in that for asset management, because it's a recurring revenue industry, and every year we start again. We have an incumbent asset base that's generating cash flow, and generally over time, as we know, capital markets go up, and so you're kind of going up and to the right if you don't mess anything up. So there is something to be said about that. TCW, very briefly for people's knowledge, you mentioned Robert Day. He's a scion of the Keck family, which established Superior Oil and Gas, which is the largest independent oil and gas company in America until it was sold to Mobil in '84. So we started managing money for the family. Now we manage over $200 billion on behalf of individuals and institutions. What's special about us is that, number one, we offer highly curated investment solutions only where we have a discernible, repeatable edge, which is in private and public credit, and parts of the equity market where we have a unique insight, like we launched an AI fund 10 years ago.
The second is that we have very different exposures from peers and benchmarks. For example, we're 15% underweight credit right now, which we can talk about more later in the panel. And we do a very different type of private credit than all of the scaled players. And actually, we're very nervous about parts of private credit, which we can talk about later. And then finally, because we're privately held and employee owned, we're very long-term oriented in how we think about everything. And it's a very strong investment-led culture. So I'll end by saying that comment, what our job is, I think all of our jobs is, how do you respect the heritage of this very special institution, but also acknowledge that these organizations have to evolve to meet future needs? And that's a very delicate tension that you have to get right. And I'll end with two specific examples of how we do that. And I'll make it brief. The first one would be exchange-traded funds. So Mike Gitlin talked a little bit about this yesterday. For a long time, the industry conflated passive investing with the vehicle of ETFs for too long. That became a $12 trillion asset class. Mutual funds were in outflows. I'm looking at Eric Pan, who's in the audience here from ICI, which I'm on the board of, and we celebrated the 100th anniversary of the mutual fund a couple of years ago. So good news, the mutual fund turned 100 years old. Bad news, we haven't innovated in 100 years. So we had to, move along. We launched active ETFs, and it turns out what the clients actually like is they like the wrapper of an ETF, the transparency, the tax efficiency, and the liquidity of it, and we can put active products into those, and lo and behold, we've raised $5 billion in that in the last 18 months. So that's an example of taking that culture and that heritage and that alpha generation and putting it into innovative wrapper. And last comment would be alternative credit. That's a place we've been involved in for a long time. Yes, I think wealth individuals should have access to it. We can talk about that later if we want to. People have talked about that a lot. Actually, though, what it matters for us, the reasons we need to be in alternative credit in the United States is that we have to be relevant to the borrower. And the borrower is the CFO. And the CFOs in the United States and around the world want more flexible forms of financing. They want to be able to borrow in private markets. They want to be able to borrow in public markets. They want to be able to lend against cash flows. They want to be able to lend against assets. The same company can be both IG in the way it's securitized against its asset, and it can be high yield in the way it lends against cash flows. And if we're going to stay at the leading edge for clients, we need to continue to evolve our platform to be relevant to the borrower. So those are two concrete examples of how we can respect the heritage of what we're doing, but meet our clients where they are now and evolve for the future. And I hope, my great hope is to make him and the team proud over time in how we do that.
Great. Thank you so much, Katie. So Tobias, moving on to you. Clearly, Katie talked a little bit about certain asset classes, which she's probably a bit more happier with versus others. Lots of conversation yesterday around, whether the market's actually overheating, given that whether it's credit, whether it's equities, whether it's gold, whether it's Bitcoin, everything seems to point to all-time highs. So as you think about, helping your clients invest for the long term, whilst navigating these, market conditions, which one's not quite sure where they're going to go, where do you see capital being deployed in your organization right now? And how do you manage risk, return, and impact?
Yeah, thank you for the opening. And I was a little bit digesting when two of you spoke about my growth, equity, whatever, because that has been a little bit under the weather. So thank you. We are definitely not under the weather, but let me first of all thank you, Eddie, for having another HKMA event, which is really stellar. And we, by end of the day, we can confirm as Allianz Investors, we are a 4-time finisher of the Global Financials Investment Summit Trail. So we are very proud of that. But leave this aside for a moment. We prefer equities over bonds over cash. And I think this is reflected in all the discussions you have heard over the last 48 hours. And if you look into the equity bucket, we prefer very much the EM piece. And this is twofold. First of all, the price momentum is really fantastic. Secondly, we have also heard the structural underinvesting of the westernized world into EM is certainly giving you a great investment opportunity. And within that, you all know that we are very long China. We truly believe China will be an asset class for itself, despite I sound like a broken record on this. And for us, Hong Kong is our gateway, and it's our second home next to Frankfurt and Munich. If you look into the fixed income bucket, we prefer a little bit more euro than US, and this is very much driven by a softer inflation. This is nothing about the tariffs and tension, it's just fundamental underlyings. And within Europe, look, sovereigns is a topic which we work closely monitoring. Our French neighbor is giving us a little bit a hard time because they became a little bit unreliant in terms of who is the next leader. And this is normally something which we have been not used to, because there was always, in Europe, when there was a crisis, Europe always evolved stronger. But it had a very strong axis between France, Germany, or Germany, France, however you want to place this. And there is now, I think, stimulus coming from Germany, and has been mentioned yesterday. So the likelihood of Germans are liked in Europe is a little bit lower than Richard. Everybody likes Richard. And Laurence, obviously, I mean, you anyhow, but you're not part of Europe as a Swiss. Oh, I forgot you're also not part of Europe anymore. So I'm the only European on this panel. I apologize.
It's nice to hear the Germans moaning about the French and not the Brits for a change.
It's television, so 30 seconds back
Are we
play.
going to have a conversation about Brexit in a minute as well?
Yeah,
because we can talk about that and change the panel
promised you
discussion.
an informed panel, right? So we will take over in a second. But let me finish that idea on also, look, the US this is not a bend or break, it's really the US currency is tested as one of the reserve currencies. And this is why we like gold, and we also like steepness on the fixed income side. And what we really like is, and that has been touched upon yesterday, is private markets. We are big in energy transition. We have heard yesterday everybody likes data centers. Please continue to build all the data centers, but do buy our electricity. Because in Europe we are one of the large providers if it comes to energy transition. So there's really, I think, enough wiggle room. So it's, as Richard said, it's really our investment style which goes beyond alpha, which we try to educate and to help and navigate in these times.
So given that, what's the portfolio of the future? Is it 60-40? Is it 60-20, 20 alts? What is it?
Look, I mean, the catch-up, it's a fantastic question, but you have seen that across the world, most of the portfolios, and this really differs between institutional investors, wholesale, retail investors, where institutional investors are much more advanced already, given the accessibility. We have talked yesterday about democratization. I don't like that democracy. I truly believe making private markets investable for retail customers and wholesale customers is the much better term. But I think at the end it will be pretty much a 70-30, 60-40 split going forward.
But to be sorry, can I just?
No, please.
Total chaos.
So I'm disagreeing already.
No, well, I am actually, because I think it depends on the investor. Because there are many people now entering a decumulation phase, and we've seen that change a lot in the last 10 years, and therefore the weighting towards fixed income is going to be higher. I think there's also, we don't talk about it enough, we're holding fixed income for the reason we used to hold it 20 years ago, which is yield, as opposed to a benefit because of the lack of correlation. So we're actually, bonds and equities are looking highly correlated, so it's really giving us yield in the portfolio, which enables you to wind down the...
I would agree, but look, the problem we have within DB/DC plans, our thinking was wrong for decades. Regulation has forced us to divest to the point when you go into your pay-as-you-go system, have not taken into account that it will most probably, as we all age better, younger, we see it here in the room, that you have to invest another 25 years if you're in retirement, and then only sitting on bonds is not a smart thing. That's the reason why I said 70-30, 60-40.
Okay, so got it. So Laurent, we're not going to be always just sitting on bonds as we look forwards. Private markets is clearly something that institutional investors have had the privilege of investing in over many years and building a much more diverse portfolio. You were famous for saying, as a lot of asset managers lean into the launching of evergreen funds, right, and making private markets more accessible to high net worth and retail more broadly. You said, be careful of making something illiquid liquid. So with that, how do you balance innovation, giving investors what they want, but then managing risk?
Yeah, I think. Well, first, private markets, are gonna grow. It's forecasted to reach 30 trillion by 2030. A big part of that growth is still going to be in the hand of institutional clients, which will be north of 20 trillion, and the rest will be in the hands of individuals. Now, 90% of that is still going to be with family offices and ultra high net worth clients. So when we talk about evergreen, I think obviously there are benefits, immediate exposure. You can also increase your exposure. You don't have to manage the commitments. But there are a few pitfalls you need to be careful about. First, I think you need to look at what's under the hood, because it's not one for one with traditional closed-end structures. There are also some asset classes that are better suited for evergreen products, shorter duration type of strategies. There's the valuation question, and most importantly, there's the liquidity question, because you're not going to get the liquidity when everybody wants it. You're perhaps going to get it when you want it, but if there's a systemic risk happening, you're going to be gated. You're not going to get it. So it's extremely important when we talk about democratizing access to private assets and to illiquids that we understand clients, their needs, beyond what they tell you, and that we really focus on the longer term part of their investments, their reserve assets. And as it happens, the wealthier you are, the more funded you are as an institution, the more reserve assets you have to invest in liquids. So my worry is that because there's an element of illusion of liquidity in evergreens, through what we call the democratization of private assets, we start to tap into the core portfolio of retail investors that need cash flow, and we lock it in liquid evergreens that are not liquid. So this is my worry, and this is why we really try to spend a lot of time understanding our clients, understanding why they invest, what their needs are, to make sure that we invest in a suitable manner for our clients.
Katie, any thoughts on that?
I agree with what you mentioned. I think we do have to be thoughtful about it. I also just want to say, someone made the comment yesterday that the death of the 60-40 portfolio has been greatly exaggerated. I do think we need to be open to the possibility that this is something more that the industry is pushing than the clients are asking for. I think about my mom, who's a retired teacher, and all of her friends. Americans aren't complaining about their retirement portfolio. Owning U.S. equity at a low fee has been one of the best asset classes to own in the world over the last 2 decades. So I actually think we've done pretty well for people in terms of capital market returns in their retirement portfolio. Is there room for improvement? Yes. Do I own some of these assets myself? Yes. But I agree with the comments that we have to think about how to structure it responsibly. And when the base rate comes down just in private credit, you're talking about locking people up for an 8-9% return. I mean, in liquid fixed income, you can do that in an ETF for 35 basis points and take intraday liquidity. So I think we have to consider the return profile of what we're asking people to buy along with the structuring of it.
I think it's a very good point. I think, the 30 trillion of assets by 2030 is going to be 20% of the industry AUM, but it's going to represent 40% of its revenues. So who has the real interest in pushing it down?
Yeah.
Is it the asset management industry, or is it the actual retail clients who want it? I think we need to ask ourselves that question.
Can I add an angle to this? If we look at the needs of infrastructure investments, if you think about Europe, because what I like about Hong Kong, and I travel on to Tokyo and Singapore, if you come back from Asia, sometimes it's fun to enter into a Lufthansa plane and they say, Guten Tag, Herr Pross. Somehow, I do fly back into a museum, right? So if you travel Europe, our need in really renewing grids, making grids available and that electricity can flow from the north to the south, where we have water, where we have wind in the south and west to east, will need governmental stimulus. And as we have seen after COVID, some governments have a very stretched balance sheet. So it will need the money from retail investors. And if you look at Germany, and I think the same is true, the savings rate in Switzerland, in the UK, look, the Germans sit, just to give you a number, on 10 trillion cash. I mean, if they would start to invest in a kind of a public-private partnership model, where somebody is taking the first loss or is doing first loss leaderships, providing guarantees via development banks, I truly believe that our industry is innovative enough to come up with vehicles like we have it on the LTIF, with active ETF on the public listed side, that we can make even complex investment structures accessible and investable while not compromising on liquidity.
So that brings me to my next question, and maybe Richard, you can take this one. Private credit as an evergreen asset class versus infrastructure as an evergreen asset class versus buyout as an evergreen asset class. All very, very different risk profiles. How do you think about that?
Well, we offer all three through an evergreen product, right? So, because I think this comes back down to, forget what we think is an industry, what does the client want, right? And I think I really will double down on Katie's point of some people want to have access. If you have asset-backed short-term private debt, that fits naturally, much more easily because it turns over quickly into an evergreen debt product. You can absolutely, one of our most successful evergreen product is private equity. And of course, we increasingly put renewable infrastructure into evergreen structures. But for me, it comes back down to what does the client want? What is their risk profile? Because again, Tobias is right, Tobias is right, we can do whatever we want to do in terms of innovative structures. That's how we've survived this long. But actually, it is what is right for the client. And I do worry that sometimes as an industry, we don't start from the client lens, we actually start from how would we like to raise assets? And the moment we do that, by the way, I don't think we're serving ourselves or the industry particularly well.
Before I come to a topic which is about energy and off the back of infrastructure, question for three asset managers. Is there not enough money in institutional pots that will help you grow where you need to? Why do you need to access the high net worth and retail?
Well, I'd turn that around the other way. What is the fastest growing source of money? It's wealth. Actually, by the way, in this region, wealth asset growth is forecast to be 2% higher than the average for the rest of the world. You look at the latest forecast for China is that ultra high net worth will explode by 47% by 2028 relative to 2023. That money needs managing. Right, so actually what we should be doing is pivoting to where the client needs us, and therefore we need to pivot into that channel, and some of it will flow into institutional channels because people will still invest in their pensions and all of those good things. But we have to service the money where it develops, but we do have this responsibility to make sure the product that we create is right for that channel and right for that individual segment of that channel.
Great. Okay. So, Katie, we slightly touched on infrastructure as part of that conversation. Clearly, the whole energy space is part of the broader infrastructure conversation. How are you thinking about investing in the energy space, sustainable energy?
So when at TCW, if I think about the themes that were most overweight across the platform, one is AI, and that's something we're spending a lot of time on as a company implementing in the way that we run the business and the portfolios. And the other is energy. And there was a great panel on that yesterday. I agree with Jean's comment. That was one of my favorites, probably because that's how we're positioned. Everybody likes to hear that they're right, so that's always good. But there was a lot of comments on there around the massive shortage that we have. And just for people's edification, in order to achieve the dream of AI, we have a lot of work to do in the US in terms of energy. And in our portfolios, we're overweight the creation of energy in alternative forms, wind, solar, nuclear. There's 90 nuclear plants in the United States. Only 3 have been built in the last 10 years. There's 10 just taken online now. And in the more efficient production of energy and storage of energy. Part of it is AI, as I just mentioned, but actually it's also because we are reshoring manufacturing and we're electrifying other things in the United States, including EV. So energy is a sector that grew effectively at zero, so didn't grow for 20 years. And now we're looking at the next 20 years and it's going to have above GDP growth. And it's an incredible place to be invested whenever that happens to any sector. When you go from below to above GDP growth, you can capture outsized returns. And that's what we're doing in our portfolios. I just want to end on a comment about society quickly and climate, which is there was a comment made yesterday, I think Eddie might have made it, that green energy hasn't been canceled in Hong Kong. And I think that's amazing. Hong Kong has a lot of amazing attributes, and China, and its leadership on this front is notable. I want to put forward that I actually think we're at a really interesting inflection point in the US, where the United States may take a leadership position in driving clean and alternative energy, but in a very unexpected and very American way, which is that we tried very hard to persuade people that it was the right thing to do morally, and we all watched Inconvenient Truth and saw the pictures of the drowning polar bears, and I don't say that lightly. Like, I am a climate victim, by the way. I lost my house in a wildfire this year, and my town, and 4 employees at TCW did, and my kids were at a camp in Texas, in Kerr County, that had a catastrophic flood. Like, I have personal impacts to climate, and our clients are struggling it with insurance companies. It's a real issue. America knows it. We couldn't do much about it. We tried hard to get around it. Nothing happened. It got politicized. Now, though, in the strategic chessboard of capitalism, to get to that promised land of AI, we first have to climb this mountain of energy. And in order to do it, we need every single type of energy, including alternative energy. And nothing motivates an American like climbing that mountain to make all that money on AI. And if there's $60 trillion of labor and we can get 15% more productivity of it, I predict you, we will climb that mountain and we will become the leaders in alternative energy, but for a very unexpected reason. That's what I think.
Okay, thank you so much. All right, so no panel is complete without talking about AI, clearly. So I wouldn't want to, make the audience feel left out that we haven't touched on it. Laurent, why don't we talk about it with you and Tobias? You've both talked about embracing AI in your organizations. Lots of discussion around, lots of money being poured in, but what is the actual end utility going to be over and above just making us a lot more efficient? So can you talk about AI in your organizations in the context of how it's going to help you make more money?
Look, I think we do not differ from anybody else in the room here. We went from a testing, piloting phase into implementation, and I think along the value chain, the most obvious pieces are what we do on client reporting. How do we help portfolio managers to digest data in a better way? But it's not healing all wounds. And look, our industry pretty much is under cost pressure. Now you can take 2 angles on AI. I mean, if you ask McKinsey, they will tell you 30% always is possible to take out cost. The problem really is, if you communicate this to your staff, it also needs a cultural shift that they accept employment of an AI employee. So do you get a completely virtual, augmented version of yourself next to you in the team? And would you accept this? And I think this is the biggest challenge in our industry, to not only convey the message that AI can certainly do a lot on the productivity efficiency side, but the question really is where to deploy quickly to showcase to staff and to clients that it's worth the way and the effort. And I truly believe this is just the beginning, and I have heard the Taylor Swift comment, so I have 2 teenagers and 1 grown-up at home. So Charlotte would say Taylor Swift, maybe. The boys would say, yeah, Taylor Swift is cool. So I have a 2/3, 1/3 at home. But AI is, look, it's unstoppable. But I think it needs to be carefully deployed. And we also have to say, if it's only about efficiency, what do we do if we let a third of our staff go? So what do you do with that? So we are rather in the camp that we want to deploy it on the top line. So it's a growth accelerator. So do more with the same amount of people is certainly the way forward.
No, absolutely. Laurent, anything to add there?
Yeah, perhaps three points. The first thing we're doing for when we look at 2030, we have a couple of principles that we have outlined. One of them is to try to be lean and mean. And what that means basically is that we're gonna,
I wouldn't see you as me.
more or less cap people and on-cap technology, and that will help us scale up and force the deployment and the embracing of AI technology throughout the organization. The second thing we do is that we've launched an AI-driven strategy where most of the investment process is AI-driven. It's been one of the most successful launch we've had in the last couple of years. So trying to bring AI in the investment process and help us be better investors.
How is it performing versus human being?
It's been performing, but it depends which human beings, right?
An intelligent human being.
It's been doing well. It's outperformed its benchmark. It's a relatively new strategy, but it's close to 2 billion now. So it's been very successful in terms of raising assets and gaining interest. And the third thing is to try to, as you know, we're quite big in thematics. Try to invest in themes where we think that are going to benefit from AI outside of the Max 7. So you can think about robotics. We launched our strategy 10 years ago. It's outperformed more. I mean, did more than double the performance of the MSCI ACWI since inception. We like cyber. We like so we have a security strategy as well. We like a biotech, which is going to benefit from AI. So try to provide those products to our clients that are going to be big beneficiaries of technology developments.
Fabulous. Exciting times ahead. Okay, folks, I'm conscious that we're out of time, so I figure we end the panel the same way that the previous panel ended. You are all regular visitors to Hong Kong. You've all got growing businesses in Hong Kong. Laurent, Hong Kong in one word.
Well, somebody said already Long Kwai Fong.
No, that's not one word. One word. I went to the man first because you normally us women talk a lot, which is why I was going to give you more time.
Energy.
Energy. No, that's not one word either, Tobias.
But look, Hong Kong is so beautiful, you cannot describe it in one word. So it's like a nuclear plant. It's cheap and endless power.
And now we wonder about Brexit. Right, Richard.
Energy.
Energy. You just said exactly what Laurent said. Okay,
he always does.
I'm relying on the French speaker.
That's what he did in the prep session as well. He was just repeating us.
You can imagine how difficult the prep session was, ladies and gents. Katie, please say something enlightening. Leadership. Leadership. Love it. With that, ladies and gents, thank you very much. Thank you, folks.
Thank you very much. Harska, you've done a marvelous job. If we can get you front and center for a photo. And once again, we've got a double hit with our official photographer down in front. And then look to the long distance for the RTHK. Thank you very much. Great job. I love the energy of this panel. I mean, the energy of Hong Kong, yes. But the energy of this panel, absolutely spectacular. All right. Wonderful job. Thank you so much. All right, great job for our panel. Another round of applause for our panel today, led by Harshika Patel from JP Morgan. Very good. All right, so thank you very much. Now, as we look forward in the world of investment, we don't know where the big picture issues or the minutiae of regulatory changes will take us. And so we have to build flexibility and resilience into our organizations. There's a little party going on down here. I might have to go sort those guys out. But we have to build flexibility and resilience into our organizations. But given the urgent demands day to day, that is easier said than done. And so we need to hear from our next panel about how we can build strength into our organizations to face an uncertain world. Hopefully, I will be able to get my panel through the crowd that is forming off to the side, because I think they're ready to go. And they are going to be led today by Albert Go. Albert is the Deputy Chief Executive Officer of the Exchange Fund Investment Officer of the Hong Kong Monetary Authority. Winging his way to the stage will be Hermes Lee, the Founder and Chief Executive Officer of Aspects Management. We have Michael J. Sachs, who is leading GCM Grosvenor as their Chairman and Chief Executive Officer. And rounding out this panel, from Citadel Securities, we welcome their CEO, Zhao Peng. And with that, the hubbub has died down, a silence falls over the crowd, and Albert Go brings his panel to the stage. Thank you.
Welcome to the panel on charting rough waters. Let me dive straight in. I'll start with Peng Zhao. Peng, welcome back. You're the rockstar CEO of Citadel Securities. Your personal journey has always inspired us. As a child, you possessed all the qualities that any Asian tiger mom could only dream about. Tall, good-looking, child genius with a high IQ. You did a mathematics degree at Beijing University, aged only 14, followed quickly by a PhD from Berkeley. And oh, you must have super high EQ too, because you worked so well with Ken Griffin for over 20 years. Sorry, Ken, I know you're somewhere out there, but this is Peng Zhao's moment. Peng, did you face any challenges at all? Were there any life-changing moments you'd like to share with us? Because it all sounds super good.
I wasn't sure there was going to be a question. I was just going to listen to this introduction for this whole session. I was hoping, but thank you, Oliver, for having me back. And I can feel. I think we can all feel the energy that's in the room, that's in the city, and that was in fact not a surprise. That was the word that the previous panelists came up when they were asked to describe Hong Kong. So growing up, so I grew up in Beijing, and with incredibly hardworking parents. I think they were the first generation of entrepreneurs in China in the 90s. It didn't feel like challenges, if I might be honest, but thinking back, my father actually worked in Hong Kong in the 90s. Which brought a lot of very fond memories. So Hong Kong always felt like a second home to me. And then I was effectively raised by my mom, by herself, in Beijing in the 90s. And while her having left her government job at the time and starting her own company. So there was a lot of responsibilities for a 10, 12, 14-year-old in the household. Both making sure, mom was well taken care of, grandparents were well taken care of, but also focus on the school. I think it was that kind of experience growing up in that era, combined with the exposure I really got from Hong Kong about what made Hong Kong such an amazing city, where the financial market, the stock exchange, really underpinned the foundation of that. That combination, in very large part, made me who I am. I mean, I ought to say one thing that people have today that I didn't have was, despite the desire to get into finance and figuring out how to apply my mathematical skills in figuring out how to trade stocks, that wasn't really an opportunity that was available to a boy growing up in Beijing, right? In the 90s, China was still just forming its own financial market. Hong Kong already had one of the greatest financial markets in the world, just like today, but it wasn't really a available career path to get a college degree in Beijing and then come find a job at one of the top tier financial institutions. But that's what's available today. So that's yet another big change. That's opportunity that we didn't have. But it all worked out, so no complaints. Yeah.
Very good. Well, Citadel Securities is now the largest market maker in the world, larger than Goldman Sachs, JP Morgan, Morgan Stanley, you name it.
It's not really a competition, but we're proud of it.
Because you're the leader. We also watched you grow in Hong Kong for over 34 years. Why Hong Kong? What advantages does Hong Kong have for Citadel Securities? Do we have enough high IQ, high EQ talent for you?
I think you're hitting on the number one reason, right? It's what Hong Kong has is this is where talent wants to be. It's really a two-sided reason, but they're strongly intertwined. I think if you talk about the quality of life, the quality of education, safety, it really is one of the greatest cities to live, build a career, plant down your family roots, raise your kids. So it's such a talent hub, and the density of talent, the amount of talent that's available across technology, finances, sales, you name net management, you name it, it's unparalleled. And at the same time, the reason why it is such, it's heavily related to Hong Kong being such a business-friendly environment. We can talk about the fact that capital can flow freely. We can talk about the rule of law. We can talk about the highly accommodative and welcoming government and regulators that help businesses while regulating us. But underneath it all is this culture that celebrates risk-taking, entrepreneurship, and the industrial people. So if you're someone that is ambitious, is willing to take the risk, willing to put in what it takes to make something out of your life and make something and build a career, this is one of the best cities to be. And for that reason, together with everything else, talent is here, and therefore we have to be here.
Thank you for that. Last year, you talked about Citadel Securities' approach to AI. You said that it usually takes old-fashioned automation instead of AI to get the job done. Bloomberg reported recently that you have an operations manual. We know that it's not a little red book because apparently it weighs 50 pounds and has 5,000 instructions in there. It is this meticulous, data-driven approach that has helped you beat Wall Street's giants in trading. Can you tell us more about how you set these goals for your colleagues? You don't need to spill the secret sauce, just tell us your approach.
Well, so first of all, it's interesting. Let me make an interesting observation first. I studied statistics for my PhD. We did a lot of the foundational work that led to the various different AI breakthroughs that we're seeing today. Even for me, I find it really difficult to both keep up and make the right decisions in terms of what areas of AI machine learning we should be leveraging in the business. So it's a little bit interesting to see global finance CEOs, the vast majority of whom have no background in AI machine learning, all speculating where's the future of AI and where this is all headed. Just want to point that out. But I think what I said last year remains true. The way we organize data, manage data, the way we map out our workflows and our processes into understanding what's the input of each one of these steps, what's the output of each one of these steps, and how does that lead to either an investment decision or talent decision or a trading decision, defines a firm. Right? And that's our job. As AI tools get better, machine learning tools get better, there will be more and more opportunities for you to embed those tools and methodologies in those little boxes in your flowcharts, in your analytics, or that big book, and there may be pages I rip out and replace it with tools that wasn't available 3 years ago. But in a way, whether you write it down or not, that book of your flow, your processes, your inputs and outputs, your technology components, your talent components, that is the firm. I think we are just a bit more explicit and a bit more hardcore, if I were to use that word, in focusing intensely on exactly understanding what that is, in understanding exactly that we're all there doing. And that's driven the firm and to deliver result we have delivered so far. And that will continue to drive us forward. And AI or not, that doesn't change. And as technologies get better, including AI, I think that process will get supercharged even more.
Thank you very much. That's inspirational. I just want to say I spotted some JP Morgan and Goldman Sachs friends over there. So you might want to walk this way on the way out with us. Next, let's move to
they're great partners of ours.
I know, I'm just joking. Hermes Lee. Hermes, you're the founder and CIO of Aspects, the most successful Hong Kong-based hedge fund that we've seen in recent years. In fact, you're so successful now you don't need to wear a tie. Now you have averaged over 30% return per annum. Your AUM grew from nothing to $12 billion in just a few short years. And more importantly, all this was done during a period where it's impossibly difficult for Asia-focused hedge funds. So first, I want to thank you for making money for the people of Hong Kong. Hermes, you are a true homegrown talent. Can you tell us about your journey from a humble local schoolboy to this world-beating hedge fund manager now?
Well, thank you, Albert. Yeah, I thought I was only invited because I'm actually from Hong Kong. Well, so yeah, indeed, I was born and raised in Hong Kong. Now you may wonder, like, do people in Hong Kong love the brand so much that like they actually even named their kid after a bag? Well, it's actually named after the Greek god of messenger. That's before the bag became popular. But anyway, yeah. So I was born and raised in Hong Kong. I went to a local school. I did the Hong Kong certificate exam. So I did my university degree in the UK, but my entire career has been in Hong Kong, and I couldn't be happy about that. Couldn't be happier than that. Obviously, there's been ups and downs. During COVID, it was very challenging times, but now it's much better. Now we even have trading during typhoon hours. What more can you want? So yeah, it's been great, and looking forward to more time in Hong Kong.
Good, thank you very much. Now, Hermes, you also changed the way HKMA invests. Now, we tend to invest in global funds like Citadel or Peng's sister company, shall we say. But under the leadership of our financial secretary, Paul Chan, and our chief executive, Eddie Yu, we created a special portfolio just to invest in Hong Kong-based managers like you. How did you build such a successful hedge fund in Hong Kong? Did you consider launching anywhere else?
Yeah, well, first of all, my entire career has been here. We only have one office. All our staff is based in Hong Kong. So we never really considered, starting anywhere else. We did consider whether we should be somewhere else too, but in the end, this is the only office that we have. And we make all our returns and everything out of Hong Kong, so I think it's a good place. Now, I think, like I think Ken and everyone has mentioned, the greatest part of Hong Kong is the ease of doing business and the talent. Not only Chinese talent, but I think we have very good multinational talent as well, which is very important for our business investing across Asia. So besides Chinese, we have Koreans, we have Japanese, and I think there's nowhere else better for Asian talent than Hong Kong. This also is really the center of the region. We have the best flow of information, all the conferences and people pass through here. So I think we can be very efficient and very effective out of here. So I think I can foresee that Hong Kong will continue to be our home.
Very good. So let's talk about how you invest. After COVID, you became one of the largest shareholder of an unknown Chinese online broker. Now, many thought that you were absolutely crazy. I mean, the markets were down, no one was trading stocks. The share price of this broker had gone down 80%, and there was even a regulatory crackdown. But in recent times, the Hong Kong and China markets came bouncing back, and everybody rushed to open accounts. So this stock went up 500%. So it looks like you're an absolute genius. Now, proving once again that the line between crazy and genius is a really fine one. Can you share with us your investment thesis and strategy?
Yeah, well, no doubt, the market has gone through some tough periods between 21 and 24, but it's really our job to sort of sift through all the difficulty and find businesses that can be resilient, during downtimes, and be able to outgrow the market a lot during up times. And Futu, as you mentioned, is one of those rare finds that we have. I wish all our portfolios are 500%, but I think having one of that has been great for us. So Futu is an online broker which started with primarily serving the Chinese and Hong Kong population, and has since expanded into regionally and globally into markets like Singapore, Malaysia, Japan, and the US. I think it's got really good products. It's got very strong sort of marketing and execution. And more importantly, I think it's really leveraged on a very important trend, which is for the Chinese population to invest or diverse their assets from likes of real estate into equity markets, for which Hong Kong is a great beneficiary of that. I think on top of that, the internationalization of the domestic A-share markets have really helped Hong Kong. For example, we've seen the sort of largest, the largest IPO this year is actually a Hong Kong IPO of CATL, and we think that with the advancement of technology, a lot more of the A-share domestic listed technology companies will be listed in Hong Kong as well as they look for capital internationally, which will undoubtedly benefit the Hong Kong markets, the Hong Kong exchange, and also Futu as an online broker for Hong Kong. Yeah, so I think certainly the market has not been easy, but the company through these means have been able to grow their profits quite significantly over time. And it's true that when we invested at the end of 2021, the stock is down like 2/3, and it looked very challenging. But over the years, through all their expansion, the company has been able to grow their earnings by 3 to 4 times. And I think so long as you're able to sit on your investment and you're investing in businesses that can grow, eventually I think the share price will become aligned with the earnings. So ultimately, the share price is also up 4 times, similar to the earnings.
Very good. Keep those up, that's what I'll say. Okay, let's turn over to Michael Sachs. Michael, you are a very rare breed these days. A senior Democrat, trustee of the Obama Foundation, top fundraiser for the Democrats. In fact, you are the reason why Democratic conventions are held in Chicago. How are the Democrats doing? How will the Democrats do in the midterms?
Question on a lot of people's minds. We're going to have a lot more information this week. Yesterday was election day. The polls have not closed in California yet. They've just closed on the East Coast and probably closing right about now in the Midwest. The results are coming in. I think that the most important thing to watch for is both turnout of Democratic voters, which is an indication of passion, of engagement, and also, very importantly, how the independent voters break, where the independent voters go. And I can say that as we were coming up here, one of the important races, the governor's race in the state of Virginia, was called for the Democratic candidate, a woman named Abigail Spanberger, first now woman elected to be governor of the great state of Virginia in history. And it was called very quickly, about an hour and 15 minutes or so after the polls closed. And it seems the independents have broken strongly for the Democrat in that race. And when we sat down, it wasn't yet called. It could be by now, and I suspect it will be shortly. Also, the woman running for governor, the Democrat in the state of New Jersey, was well ahead with about 35% of the vote in and looking like she was going to win. And that's also good Democrat turnout, but significant shift among independent voters. Interestingly, 2 women, both absolutely moderates, absolute, set down the center of the political spectrum. And the campaigns focused on 2 things. One, pushing back against the president, and that was a significant percentage of the ads that were run in the Virginia race were essentially not running against the opponent, but running against the president. And 2, affordability. And affordability, which is, I think, a roll forward of our conversations about inflation and some of the results that we saw in the elections in 24, is very clearly front and center. They talked about affordability, I think not as aggressively as the mayoral candidate in New York, the Democratic Socialist mayoral candidate in New York, Mamdani, pushes a affordability agenda, but those were kind of the themes. So there will still be a fight for sort of, I say, the soul of the Democratic Party, how progressive, how centrist. But these elections this week and what happens out in California on Proposition 50 which will redistrict California to create some more Democratic seats in response to what was done or about to be done in Texas, will have an impact on how the races are run in the fall of next year. And I think, who's in control after those races. And while it looked pretty dark for a while, I wouldn't count the Democrats out completely yet. So,
good. Switch back to Hong Kong. So, Michael, you have been one of our trusted partners in alternatives for many years now. You have also helped us build up our Hong Kong-based manager program. Could you tell us why Hong Kong is still the largest base for hedge funds and private equity in Asia?
Sure. To some extent, it's almost like a trick question to me, because when you look at it, there's really not it's not much of a conversation. It's not like a close conversation. The conversation is Hong Kong, London, Hong Kong, New York. It's not Hong Kong, other Asian capitals, and a place to base sophisticated investment operations in Asia. It's a hands down winner. I've been coming to Hong Kong since the 90s. From the minute that the airplane would make that hard right turn to go into Kai Tak, your pulse would kick up, your adrenaline would kick up, and you would feel that the entire time you were here in the city. Literally, we were coming out here to look for investment opportunities in the early mid-90s, and it was one of these privileges. I know I'm talking to a hometown crowd here, but where you would experience a city that actually vibrated, that you could feel the energy of the city. COVID hit Hong Kong hard. Had a lot of change. COVID hit Hong Kong hard, and I think it tempered some of that for a while. People left and pulled back on their Hong Kong operations. But it feels to me like that's in the rearview mirror, that energy is back and is very real and strong. And all of the fundamental, I almost would say like structural or architectural advantages of Hong Kong, the talent pool, the educated workforce, the quality of life. I was with somebody yesterday, they were talking that the commute has gotten up to about 25 minutes from someplace, and it's kind of it's 25 minutes, it's actually a commute. Come over to the United States for a while, live in one of our big cities and see what a commute is. So it is the quality of life, the culture, it's just all, there's no real competitor in the region, in my opinion, for a service business, for a financial service business, that needs access to markets, ability to travel, rule of law is great. And so it will stay the leader going forward, in my view.
We have many important people from Hong Kong Inc. in this room. Is there one thing that Hong Kong can do better?
Well, I would say I am not the expert on what I would call the small technical improvements in markets and funds flows and things like that. So I'm not the best to speak to, go to T+1 instead of T+2, and will that really matter? What I can say is I think the Secretary just nailed it this morning, which is just keep innovating, keep this strategic view in these goals to continue to get better and better. And I think that the one country, two system policy is a very valuable one and a good one, and staying committed to that is a big deal. And to the extent that happens, it's very hard to stop Hong Kong, in my view.
Thank you very much, Michael. Okay, we have a few minutes left. By tradition, we will end this panel with some quick-fire questions. Now, the rules are very simple. Do not think on your feet. Just shoot from your hip. There are no wrong answers because on this panel, you will be right about everything. And you cannot chicken out, okay? So, first question. What is one word or phrase to describe your outlook for 2026? So this year, Jamie Dimon said cockroaches. Elon Musk said $1 trillion. By the way, he meant his pay package, not a sales target. Peng, what is one word that you will use to describe your outlook for 2026?
Busy.
Busy. Good busy, bad busy.
I think there's just going to be a lot of activities. Yeah.
Okay. Michael?
Cautious.
Cautious. Okay. Good one. Hermes?
Broadening. Broadening. I think leadership to broaden from AI to non-AI, from US to perhaps more market like China.
Whoa. Okay. Good one. Okay. Next. What is one job in finance that you believe will not exist in 5 years? Now, I think I'm going to start with Peng because Citadel Securities has been, wiping out a generation of stock traders out there. But Peng?
Well, surprisingly, there's still floor traders on wherever there are still floors. So I'm going to be a little. This is going to sound contradictory, but I would say. Chief AI officers and head of AIs because it's like we don't have head of internet. We don't have head of mobile devices. We don't have head of personal computers. I think it would just be part of technology, right? It would be very much normalized and mainstream. So we're not going to have chief AI officers anymore. Yeah.
Oh, very good. Very good. I thought you were going to say, as a US CEO, Chief Sustainability Officer or something like that. Michael?
For us, jobs that were very heavy data entry focused. We're seeing progress on that already. We have thousands of investments, and in the private markets space, reporting on those investments is anything but standard. Some administrators have standardization, and so you can get the same report for a handful, but it's different for everybody. And it used to be very, very hard to use any automation or machine learning to ease that process and with quality assurance. We've seen significant improvement in that in the last, 6 months, and that's going to continue.
Hermes?
Research analysts who only compound known information rather than making judgment. Because AI can be much better at compiling information more accurately and faster, but only human can make good judgment.
Very good. Okay, next, without data, you're just another person with an opinion. What is the most important data set that you access or use every day and you find indispensable? Peng?
Well, it's going to be hard to resist saying it's P&L and risk. I mean, obviously, we stare at that all the time. But I think if I have to choose, I'll choose talent data over everything else. I think I can't imagine a state of the world I don't get to see my P&L in real time, as long as I can trust that I have the best team and they're working on the right things. So I think talent data for me is the one crucial thing that I cannot live without.
Okay. Michael?
So slightly maybe different answer than expected. All kinds of data for business. You're looking at your performance all the time. You're looking at your client interaction all the time. You're looking at calendars and what different people in your team are doing all the time. Lately, as I've gotten older and started to think more about the different milestones I want to participate in with my grandchildren, who are young, personal health data is something that I find myself looking at more often, including for now the last 2 months a continuous glucose monitor mounted right under here. And I can tell you all that when you take the skin of the duck and dip it in the sugar and eat it, it tastes very, very good, but it's not the best for the stability of that graph that you get on your personal phone.
So you enjoyed dinner last night?
I love fantastic.
All right, okay, good. Hermes?
Well, given how much AI is talked about today and yesterday, and given that everybody seems to have an opinion on whether it's a bubble or not, whether it's positive or not, I think the only like North Star to assessing that is the ultimate demand indicator, token consumption. So I look at that to determine whether we are in a bubble or not.
Okay, very good. Okay, last one, quickly. What will be the biggest surprise for 2026? Now, last year, our panelists all said world peace. I think they came close with fewer wars, but not quite there yet. I'll start by saying when I tested this question, I came across a good answer. And that is, despite the appointment of a dovish Fed chair, the Fed remains independent. Ooh, okay. So maybe that's wishful thinking, I don't know. But maybe let's start with Peng.
So, I go back to the first answer I gave, which was, I think 2026 is going to be a very busy year, but I think maybe disappointingly, when we come back here and have this conversation again, a lot of the fundamental tensions in the system will not be resolved. We still don't quite know whether AI is a bubble or not. I think a lot of the fundamentals that is driving geopolitical tensions will not be resolved. And so there will be a lot of activities, but not necessarily resolution to a lot of the puzzles and challenges that we have in the world. So ironically, it's going to be more of the same next year, I'm afraid.
Michael?
So I'm going to give you 2 quick ones. The first one, I don't know if it's really a surprise, but I want to pander to Eddie and to the HKMA group and say that when we're here next year, we will be celebrating that Hong Kong is number 2 on the Global Financial Centers Index past London. And that's a prediction, but I don't know that that's a surprise. I think that we can see that. The surprise, I think, and this is a surprise because I don't think it's viewed as high odds, the traditional checks and balances associated with the legislative branch of the US government may re-emerge in the coming year. If these elections indicate that the Republicans are in trouble, you could see Congress, more members of Congress start to stand up and push back and require some of the oversight that is technically supposed to be taking place. And I think that is not viewed as likely today, but I think that is a possible surprise or change that we could see.
Thank you, Michael. Hermes?
I think the China market has done pretty well for 2 years in a row now, but we still see a lot of people who said, they would never invest in the China market again after COVID and after all that. I think we might find some of these people putting some Chinese stocks back into the portfolio next year. People have short memory after all, and they like performance.
Broadening. Thank you very much. We're out of time. Please join me to give panelists a round of applause.
Thank you very much. Marvelous job. Gentlemen, front and center for a photo. There we go. All right, and once again, have a look to our official photographer right straight down the middle, and then adjust your gaze to the long distance for RTHK, Hong Kong Din Tai, for those of you that listen to a little bit of local radio. There we go, and I do like an old Kai Tak airport story. So that was much appreciated. Fantastic. And there we go. The long gentleman, and away you go. Thank you very much for joining us today. All right, good to see you. It was great having you guys. Thank you. All right, great job. Now, the people in this room are responsible for devising complex strategies to choose, to hedge, to diversify, to optimize So many factors like liquidity, time horizons, access, and so many more. But this is a very complex business. It's difficult to make sense of it, and then you put the public and private markets, the interplay between them, and the role that alternative investments play becomes a very complex picture indeed. And the question is, how do we make any sense of it? I will tell you how. We invite Martin Metsoy to come and join us with his panel. Martin is the former Chief Strategy Officer of the Exchange Fund Investment Office. He's ready to go, and here they come with the HKMA. He's joined today by Nicholas Gioc, who is the Managing Partner and Chief Investment Officer at Farallon. Also joining us is Chris Gradell, who's the co-founder and CEO of PAG. We've had his other co-founder on this stage a few times. And Tony Yoselev is the Managing Partner and Chief Investment Officer with Davidson Kempner. And with that, we're ready to go. Martin, please take it away.
Hey, thank you very much. First, what I would like to do is just set the stage for this panel on liquid alternatives. So we've heard a lot about illiquid alternatives, private equity, and real estate in previous sessions, and now we would like to turn to liquid alternatives reconceptualized. And for that, to set the stage, I had three quick slides I wanted to show you. The first one is just introducing our panelists, where they're located, how long they've been in business. So it's a 20 to 40 year story with presences in San Francisco, New York, and importantly with Chris in Hong Kong. And you can see the AUM figures on the board as well. So next slide is regarding what I am referring to as the hedge fund or liquid alternatives world with respect to the traditional asset classes and illiquid alternatives. So you can see that if you add up listed equities together with liquid fixed income markets, you wind up with a figure of close to 250 trillion US dollars. And that compares to roughly private equity and real estate markets, which we've been talking about, which are about 10 trillion. So hedge funds AUM is roughly 4.5 trillion. So those are the relative orders of magnitude that we're talking about. But the influence of hedge funds is much larger because of the use of leverage, which we will talk to a little bit later on. And the final slide, which will lead up to my first question to our panelists, is recent performance of hedge funds, volatility, correlation to long-only markets. And there the story is, for the industry as a whole, attractive returns, low volatility, and in fact, these panelists evidence even lower levels of volatility and low to negative, at times, correlation to equities. So the first question that I'd like to ask Nicola is, what is the role of hedge funds in an investor's portfolio? So when I was previously at HKMA looking at the hedge fund portfolio, it had characteristics, this is 20 years ago, of absolute return asset class, so LIBOR plus 5. And then 2009 happened and the portfolio was down, the market as a whole for hedge funds was down close to 15%. So absolute return and then minus 15%. And then since then, it's known more as a alpha asset class. So Nicola, what is your view on the right way of thinking about hedge funds in investors' portfolio?
Thank you very much, Martin. And of course, thank you to Hong Kong and the HKMA for having us. And congratulations to the HKMA for the fantastic organization of this event. So thank you. I think hedge funds encompass a wide variety of strategies, so maybe it's easier to describe what we're focused on delivering. And of course, the first and foremost, what we're delivering is excess return. And when I mean excess return is a return that we generate above the systematic risk that we take. I think we've been having a lot of discussions over the course of the past day and a half around the big systematic risks and shifts in the world. And what we're trying to deliver is uncorrelated alpha generation. And so when I'm thinking about our portfolio, it's about whether this management team in this listed company in Japan will actually follow our proposals which will enhance value. It's about whether the antitrust regulator in this merger will approve this specific deal or not. It's whether we, with perhaps a few other creditors, will be able to restructure the balance sheet of this company or that company. And so the sum of all those idiosyncratic risks should be uncorrelated to systematic risk factors, and that's how we generate returns. And so indeed, I think the 500 basis points over SOFR is a benchmark. I think the expectations of the industry as a whole is also to at least match equity markets over long periods of time. It's a little bit harder when they are going up 20% plus a year every year. But that's certainly the target, with a volatility which is much lower than that. And so we provide this excess return, uncorrelated idiosyncratic risk, and that allows people in this room, allocators, to build a portfolio on that. So beyond the excess return that we provide our LPs. We don't think of them as client. We think of them as partners, to build a portfolio where they can take more risk, take more systematic exposure, say on the AI trend, say on the energy prices trend that might happen in the US, outside of us, and they can take that directly, perhaps in a different fee structure, and we are a complement to that. I think we also provide, as hedge funds, liquidity appropriately for our LPs when there are drawdowns, because hopefully we have more upside capture than downside capture. And finally, certainly as a multi-strategy fund, we have a business, of course, with an office in Hong Kong. We've been here for a long time. Actually, this is where I started my career in 1994. But we have businesses in Europe, of course. We've based in the US and in Latin America. And we do, all the strategies that we do, merger arbitrage, we do fundamental strategies, we do credit. All of those around transitions. We capture transitions in corporate events, in businesses, in regions. We have a lot of bottom-up intelligence on big trends, which help our clients, our partners, allocators, to build also on their portfolio. So I think that's where we provide as well market intelligence that's very live.
Okay, good. Yeah, thank you. Chris, from your China chair, can you give us a view on the role of hedge funds?
Yeah, I mean, when I guess I first learned what a hedge fund was in early 1999, I did an internship at a small $400 million hedge fund in New York called Millennium Partners. And, I thought, wow, this is really cool, generating low volatility, absolute returns. I thought, wow, that's actually what got me excited, really, in the investment world. And, we, PAG, started as a hedge fund business in Hong Kong. And hedge fund is still an important part of our business. We're more diversified now as a firm, also across private markets. But on the hedge fund side, the business has evolved. But I think at the core of our hedge fund business is generating absolute returns, not losing money, low volatility, low correlation. That's what we're trying to do. And if we can generate, low double-digit returns with low volatility and correlation, and liquidity, and there's a lot of hedge funds these days who don't offer liquidity anymore, even though I do think that's an important part of the value proposition of a hedge fund. I think, why wouldn't you want that in your portfolio, right? I think that's a product that should be in every portfolio. And our hedge fund business has evolved a little bit over the years. I think two sort of big changes in our hedge fund business. One, we started, in 2002, and we started doing more also private debt type investments through our hedge fund. And I have to say, it's why I'm a huge skeptic on these semi-liquid products, these sort of retail wealth products on privates, because from personal experience, managing liquid investments in an open-ended structure is extremely difficult. And, we decided, we would not do that anymore. Open-ended funds are liquid. Illiquid investments go into closed-ended funds. So that was one change. And secondly, we now manage 4 different hedge fund products. And 2 of them are CIO-driven. So there's an individual who's really driving that strategy. And I think they're super talented, doing an amazing job. And then we have two products which are related, which are multi-manager, which is more the millennium, type model where we have 70 portfolio managers running different strategies, and we allocate capital. And I think, there's room for both of these models, they have their pros and cons. But I'd say, the objective is always to generate those absolute returns. We're not again, there's lots of different flavors of hedge funds, people who take different levels of directional risk. Our products, we don't, and I think it's something that can fit in multiple portfolios.
Okay, thank you. Tony, how would you answer that question? And maybe you can reference your recent research piece on hedge fund behavior in current higher interest rate environments.
Yeah, sure. Happy to. First, as a starting point, though, thank you to HKMA for hosting this amazing 2-day series of events and for inviting me to speak here today. I spent a lot of time thinking about this question. So I've been at Davidson Kempner since 1998. I was 24 years old when I joined. And there was a dramatic change in how people think about the role of absolute return in their portfolios in the last 10 years or so versus in the early days of my career. In the early days of my career, absolute return was thought as both a return driver in the portfolio, but also a ballast and a volatility mitigator. So the expectation was that you should be able to earn at least the rates of return that you want to earn on your overall portfolio from absolute return, but it should provide other benefits to the rest of your portfolio. I mean, the reality is, while beta may have had a good several-year stretch, most allocators can't only own beta. Most allocators have a spend rate. You have to actually spend roughly 5% of your assets plus or minus in a year to meet your mission. That works very poorly with beta because there's very high volatility in terms of those returns. Absolute return strategies allow you to mitigate that volatility. So if you were to look at the role of absolute return strategies, or at least as allocators thought of them in the second half of the 2010s, so let's say 2015 to 2019, people still considered the volatility mitigation and the ballast characteristics of the portfolio, but they were a little bit less driven by the return portions of the portfolio. And the idea was we were going to make our returns in the equity length strategies, so private equity, venture capital, growth equity, maybe public markets, and we only expected AR to basically be a mitigator. Obviously, in a year like 2022, and quite frankly in the last 3 or 4 years in private equity and venture capital strategies, that's been a terrible idea because those strategies have actually produced very little rates of return. Venture capital, as an example, has good decades and bad decades. You made a lot of money in venture capital in the 2010s and the 1990s, and you made practically no money in venture capital in the 1980s and the 2000s. Like, these things go very long periods of time. And so the last 3 or 4 years, absolute return strategies have been the best return driver, quite frankly, for most portfolios, especially once you include 2022 in the mix. And so the question I tried to answer is, like, why is that the case? And so we looked at over 30 years of Cambridge Associates data on rates of return, and what we found out is that there's a very high correlation between where interest rates are and what returns you can earn in absolute return. But it's not just a 1-to-1 ratio. You actually get an extra oomph in times with higher interest rate environments for absolute return than you get in lower interest rate environments. And the reason for that simplistically is dispersion in markets. You have a lot more dispersion in both equity markets and credit markets in higher interest rate environments than you have in lower interest rate environments. And interest rates do simplistically cause there to be winners and losers in markets. And if you look fundamentally about what an absolute return strategy is, whether it's a relative value strategy or whether it's a event-driven strategy, fundamentally it's in the difference between separating winners and losers. And so I personally think the 2020s, and you've seen this in the returns in the last 5 years, are a decade of absolute return being a a very strong strategy in a decade where people are going to be able to look to absolute return to at least earn the overall rates of return that they expect to earn off their portfolios. But it's not random in terms of why this has happened this way. It really is about the record rise of interest rates that you had in the Western world in 2022 and 2023. And I think that story has many years of legs to it. And we did publish a white paper on this, which is available on our website.
Right. Okay. Thank you, Tony. So, Nicolas, Chris mentioned earlier the subject of credit. And there's been earlier discussion regarding where we are in the credit cycle. And your industry and fund have the ability to look at a variety of private credit asset classes, ranging from distress to loans to leveraged buyout companies. So I guess, where do you think we are in the private credit cycle? And what do you think of the entrance of private credit funds into your business?
Thank you very much. So the credit is and certainly the credit cycle is a multifaceted question. Obviously, we do and we invest in credit as part of our hedge fund with liquidity available to our LPs in the second, where we do a lot of trading in the secondary market. And obviously, we are in a world of very, very tight credit spreads. I think probably in the bottom 10 decile of credit spreads in the history. So there's very little. There's a lot of financing conditions. Let's put it that way, are very positive and accommodative. But at the same time, the percentage of credits which are going through restructurings, either in court or out of court in the U.S. and Europe, at 5-year highs. So there's a mix. There's a mixed opportunity set here for us. Well, there's an opportunity set for us in our restructuring business, less so in the new origination business. I think the question that you're asking is about, the benefits of investing in private credit perhaps now, and how that's competitive. Some of the asset managers that we've heard it before are competitive with what hedge funds and our private capital does. We are more in the special situation business. We're looking for assets that we don't need to lever in order to generate our double-digit rates of returns, and so that is the intrusion of private credit has been a competitor to the loan market, the syndicated loan market, to the bank market. And there I would just say that, there is sort of an all-powerful laws on future returns for credit. Yes, they start off with your current, with the spread and the total return at inception, the yield to maturity, and your expected loss. We are at all-time lows in terms of credit spreads, and rates are likely to come down. And at the same time, the past 10 years worth of losses are at, in most U.S. and European markets, are historical lows as well. So future returns might not be as good as past returns.
Thank you. Tony, what would you say to that question about where we are in the credit cycle, and what do you think about the entry of new private credit players in the market?
Well, in terms of the second question, credit is a very broad asset class. And so I think the place that you've had the most impact of private credit has been in direct corporate lending, particularly in the United States, where you've got a direct corporate lending market that is give or take the size of the bank syndicated lending market, depending upon which stats you look at. And the reality of that is there's been a race to the bottom in terms of the covenants that are provided, the coupons that are earned, et cetera, to the point where I would say a lot of that lending doesn't look that different to what actually exists in the bank syndicated lending market. If you look at where we are in the cycle today, people like to cite a very artificially deflated default rates. And I'm really going to speak about the United States in terms of numbers here. But the reason for that is in public markets, you have what are called liability management exercises, which is that borrowers go to lenders and say, we know you owe your par. We want to pay you 80 cents, and we're going to play games underneath our documents to make that work. So when you add in liability management exercises, you have a middle single-digit default rate for the last 2 years. And I think that is the real rate of defaults in the public markets. In the private markets, it's a little bit different because there's only a handful of lenders. So they say, what? We know you owe us cash interest. We're just going to pick that interest, and we're going to pretend it's meant to be picked the entire time. So when you look at non-voluntary pick interest in those markets, again, you're at mid-single-digit default rates. And if you were to go back to the 2000s, which was a market that was really a market of bank syndicated lending, that was the average default rate in the 2000s in an interest rate environment that's similar to today. So I think that rates of return on this asset class were dramatically overstated the last few years, and I really mean private credit. People talked about double-digit interest rates, which maybe you could earn for a year or two in 2022 or 2023, but this is really a middle single-digit asset return class. And you've already seen this response in public markets. If you look at BDCs, they've traded down dramatically this year, and they're now trading at discounts, which historically is where BDCs traded, not at modest premiums. So the public market is already reacting to this. The reality is it will probably take a while in the private markets for people to show this in their marks, but that's where things are. You know, similar, I think, to the two firms here, we are doing loans that are much, we take on a little bit more risk for a lot more return simplistically in our loans, or we take on a lot more complexity sometimes in our loans, and you don't take on that much more risk. So we're typically doing double-digit type lending in what we're doing. That's a very different market. I would say that market is far less saturated than the direct corporate lending or in the asset-backed world, the investment grade market is. And so the supply-demand dynamics in that market are actually much better, quite frankly, in part because there's been a lot more competition. And I think for some of the reasons that I spoke about with what's going on in the broader markets, it's actually creating more opportunities, not less.
Okay, thank you. So moving to the China region, Chris, your fund has China tilt, Asia focus. So what do you find interesting in these markets for the deployment of capital?
Yeah, I mean, most of our funds are regional, so we're constantly looking at the relative attractiveness of opportunities across the region. And that adjusts, right? As a cycle changes, as opportunities, we shift between them. In China today, we are leaning in on the public equity side. We've seen very strong dispersion. Our equity long short portfolio manager has been doing phenomenally well. We've been leaning in on convertible bonds. There's been a lot of issuance of very, very high quality companies. I think this is something that's not really appreciated. Now, Asian convertible bond market is now much larger than Europe, and 80% is large cap investment grade. So, Asian convertible bonds, if you look at the biggest issuers this year, Ping An, Alibaba, in the US, they're mostly crypto companies. So again, I think this is something which not many people have fully realized yet is the markets, and obviously Hong Kong, China are the biggest part of that. The depth, liquidity, and quality of companies is been increasing all the time. So I think that's really still a long-term trend. We're less active on credit side in China. A big part of the credit universe in China was always also the property sector, where there's still a lot of balance sheet repair going on. And right now, interest rates in China are low, so anyone credit-worthy can borrow very cheaply. So on the private debt side, China's not very interesting. And then we're active on the buyout side and private equity as well. We like China. Actually, valuations are cheap, debt is cheap, there's almost zero competition, and there's some great companies. So, so very much in China, we're very much equity focused, public and private. We are less active on the private credit side and less active on the real estate equity side as well.
Okay. Nicola, how about your firm in terms of deployment to the region or China?
Yes, I think our focus on the region has really been focused in China has been around the Hong Kong market, indeed convertible bonds, long short equities, and it is currently a reasonably small portion of our allocation. We've been invested also in Japan for a very long time, and that has been an area of the market that's taken a big proportion of our general fund allocation and of our private capital deployment with this corporate governance transition, which is a very long-term opportunity set for us to capitalize on.
Right. Okay, thank you. And Tony, China versus India, your firm has a view on that in terms of capital deployment.
Yeah, it depends on maybe which asset class. So first of all, we've been investing in China for a long time, not as long as some of these folks, but for a reasonably long time. And we actually opened our Shenzhen office in, I think, 2021 during the middle of the pandemic, which was certainly a bit contrarian at that period of time. I would say in China, there's really been two places we've been focused. We do a lot of public bonds in China, so a lot of opportunistic credit, but really in the secondary market. We've done a little bit of direct lending there, but it's a smaller part of it. And then I will echo Chris's comments. The convertible arbitrage market in China specifically and in Asia in general, we think is a fantastic opportunity set. I will say there is more going on in U.S. converts just beyond crypto, but the Asian market's really, really strong in terms of a place to invest. We've been doing a lot in India in direct lending. Probably if you were to just look at what we're doing on the opportunistic credit side, we're more active in India today than we are in China, which is not to say that China's not a good market. It's just India, there's more going on. But India does not have the convert market or some of the other factors that we can invest in China.
Great. Okay, thank you. I'd like to, take a step back and bigger picture. So the subject of this conference is tracking through shifting terrain. And, the IMF recently released their latest financial stability report, which they named Shifting Ground Beneath the Calm. So a lot of terrain analogies here. And one of the risks that they highlighted was the risk of non-bank financial institutions and the exposure that deposit-taking entities have towards non-financial institutions like hedge funds. And the figure they cited was close to $4.5 trillion US dollars. So I know each of you can only speak about your own firms, but in terms of how you think about a important systemic event taking place in your industry, I mean, how would you assess that risk, Nicola?
I mean, as always, the risk to the system are when there's not enough loss-absorbing capital, and that tends to be correlate, and that's what creates a risk when the losses do come if you just can't absorb them, and that's typically because they're levered, and when the hit ultimately hits the leverage providers, Our portfolio is very conservatively structured. Our long assets over equity are 120% only of equity. So the idea that hedge funds, I think, like the ones that are at this table, would create a systematic risk exposure is very low. But there are a number of big trades, especially around fixed income arbitrage in the world, which do have the capacity to create systems, but to create systematic risk. Having said that, there's such large systematic risk that they might trigger the intervention of monetary authorities. And by and large, I would say that certainly in the private credit world, there's plenty of I feel like there's plenty of loss-absorbing capital there, i.e., the investors in the fund directly might have to bear losses, but it's hard to imagine that the banking institutions that are providing the leverage there would be at risk.
Right. Okay. Chris, any views?
I think certainly from the private debt side, my general feeling is the sector is not quite big enough yet to be really a systemic risk, but I think there are areas that need watching. I think liquidity mismatches is one, private debt being funded through open-ended vehicles, and there are even private debt firms, in Australia funding themselves with daily liquidity retail funds. So I think always when there's a liquidity mismatch, that needs to be watched. I think it was mentioned yesterday, the insurance, using insurance to fund private debt and other alternatives. I think that needs to be watched carefully by the insurance regulator. I think there are also some maybe less institutional private debt firms. Again, in Australia, there's an example, there's been sort of a few sort of scandals in the papers recently of private debt firms, lending to their own projects, charging excessive fees, etc. So, I think probably needs to be a little bit more oversight and regulation as well. But my feeling is it's not big enough yet, but I think there's some areas to watch probably.
Okay, Tony?
Yeah, I mean, look, there's the great Warren Buffett saying that when the tide goes out, you figure out who's been swimming naked. And there's always a little bit of that when markets retract. I mean, look, if you want to poke holes in asset classes, you can find them. So in the absolute return segment, again, the firms that are up here use very little or no leverage. There is a whole universe of funds that are levered 5 times or 8 times, and that's when accidents tend to happen, is when you magnify risk and leverage. I mean, I've been reminded a lot of the long-term capital blow-up in 1998. That was a leverage story. A lot of those were basis trades that ultimately would have worked out, but they just put too much leverage on them, and in that case, the financial system was not willing to absorb the losses. You know, in the private credit world, you've had a recent bankruptcy in the U.S. called First Brands, which has gotten a lot of attention. It's in no way, shape, or form systemic, but relative to what's not particularly a large capital structure, it's gotten a tremendous amount of publicity. And some of that relates to people who were doing factor receivable investing, and they were probably telling their investors they had Walmart receivables, but it turns out they had First Brands risk, and a lot of that stuff may be worth zero at the end of the day. So, you know, these things do go in different ways. But in terms of like what's going to be more systemic, I worry much more about things like potential overvaluation in equity markets, right? Money chasing things like AI that may indeed be a transformative technology. You know, I listened to a number of the sessions yesterday, and people were comparing AI investment to the railroads, basically saying, don't worry, a few companies will go bad, but it'll all work out. There were many large financial panics in the United States in the second half of the 19th century and the first part of the 20th century involving the railroads. And the railroads were a massive value destructing thing for investors in the entire lifetime. No one ever made any money in the railroads. It was great for the United States to have a railroad system. It was absolutely terrible for investors. So this idea that we're going to have some winners and losers and it's all going to work out, like, just think about that. Like, it may work out over a very long period of time, but you could have massive carnage getting from here to there. So that's probably not the best analogy for people to be using.
Okay, thank you very much. So I'd like to express my thanks to our panelists, and thank you very much.
Thank you, Mark.
Great job, Martin. Thank you so much. Gentlemen, once again, if you can make your way to the front, our photographer is ready for action. Quick look to the close one, and then off in the distance for RTHK. With that, we are going to take a 10-minute break. It is only 10 minutes, so please make sure you are hydrated, unhydrated, however, whatever works for you, and be back in your seats in 10 minutes, ready for more action. We are leading off with AI after the break. I'm Andrew Work. Thank you. swing doors. Ladies and gentlemen, last chance. We are on a 30-second countdown to starting up again here on the stage at the Global Financial Leaders Investment Summit. Please return to your seats. Thank you. Let's close. Send them around. Send them around. Oh, just under the wire. Let's shut her down. Without Eddie. Okay. All right, and with that, we are back in action at the Global Financial Leaders Investment Summit. Conversations with global investors. Thank you for getting back to your seats. Now, you have heard AI mentioned much on this stage today, but now it takes center stage. If the eye-popping valuations of artificial intelligence companies haven't caught your attention, I'm sure the fact that your staff are applying them to your strategies, perhaps willy-nilly, has got your attention. And so we really need to take a close look at this sector and how it is transforming our businesses. We've got the best people to do it on stage this morning. Samson Wong is going to be leading our panel. He is the Chief Investment Officer for private markets with the Exchange Fund Investment Office of the HKMA. Joining him up on stage is Richard Liu. Richard is the founding partner with 5Y Capital. We have Devin Perek, who is the managing director at Insight Partners. And finally, David Siegel, co-founder and co-chairman for 2 Sigma, is going to be joining us here on stage. So with that, we're ready to talk AI. Samson, please take it away.
Well, thanks everyone for joining the Real AI panel today. Artificial intelligence has firmly cemented itself as the defining megatrend for investors. We are seeing its staggering potential unfold this year with agentic AI automating workflow, generative video becoming mainstream, and robots achieving unprecedented dexterity. The opportunities are vast. Fear of missing out and you only live once are terms that we keep hearing. But I think most of us would agree that the risks are also significant, from inflated valuations to implementation challenges. That's the core of our discussions today, and we are fortunate to have three very distinguished panelists. In the first half of our discussion, we will focus on talking about AI from an investment perspective. Then we'll zoom out to talk about the bigger picture and the future of AI. And I would say that I have been through a lot of panels before. We probably have the most interesting pre-panel meeting in the room before this. And I have encouraged my panelists, just don't be shy in front of cameras. So we'll see. So let's begin with probably one of the most difficult questions. And we'll start with David. AI and quantum computing are making inroads across industries, including investment. For instance, the recent HSBC-IBM collaboration used quantum computing to improve bond trade predictions. David, from your perspective, how can these technologies drive real-world investment outcomes today, and what transformation shift do you foresee if they become mainstream?
Well, I'd like to start by saying that AI is a very general term, and it refers to not just ChatGPT kind of large language models, but to various forms of machine learning and even systems that rely on technology that's 30 years old. And so for people to say that AI is only now being applied to, for example, investment management, I kind of laugh at that a bit because I've been basically doing that my whole life. The use of data and algorithms to make better decisions is nothing new. And there are a variety of AI methods, including large language models, but not limited to large language models, that are really good for making predictions. And investing is often about making predictions. So the technology for making predictions keeps getting better, and the data available for making predictions keeps getting better. And so it's very likely that this trend that algorithms will be used to make more and more important investment decisions will just continue. It's a different question to talk about, for example, quantum and how that's going to be used. Advances in quantum are quite significant, but that's really, in my opinion, not around the corner. I mean, I would not anticipate that most people are going to be buying a quantum computer and incorporating it into their business. I think the bigger issue with quantum is more at a government level, where people are concerned that it'll break encryption, and this is an issue for banks, of course. In fact, it's an issue for the entire internet. It's held together with encryption. HTTPS, the S, is actually at risk if quantum computing becomes real. And so my real concern with quantum isn't about how it's going to make better investment decisions, which I think is a long time away, but more about a breakthrough that occurs and then all of a sudden the internet doesn't work right for pretty much everything.
Thanks, David. Devin, Insight has invested through multiple technology cycles, from PC to smartphones. Drawing on your experience in SaaS, software as a service, what is the next for enterprise software? And will current SaaS giants successfully embed AI, or will they be overtaken by the AI native companies?
Do I get the next 25 minutes to answer that question? But first, Samson, I want to thank you for having me here, and thank you for the long HKMA partnership. We do really appreciate it. I think if you think about these transitions and you think about mainframe to client server, and then client server to SaaS, and then SaaS to mobile, and then kind of this AI, what you've seen in every one of those transitions, which is not surprising, is that some incumbents won in those transitions, and many incumbents lost, and new entrants came in. Salesforce would be an example of somebody who Siebel owned that market and should have continued to own that market, but Salesforce disrupted it by being a cloud solution early. And so I'd anticipate that you're going to see the same thing here. But I think that the way I would try to contextualize it is think about what are the companies that have the highest risk of disruption, or what are the characteristics of incumbents at the highest risk of disruption. And what I would say is if you think about software very broadly defined, you have horizontal software. That's relevant in any industry. I mean, Salesforce would be an example of that. HKMA can use it, a manufacturing company can use it, Insight can use it, but we all use it a very different way. And there's not the business process or data is not necessarily for our industry. And so we kind of customize it for our own use. And so if you talk to lots of customers, they would say, well, Salesforce is fine, but it's not great for me. Well, that has the highest risk of AI disruption because you can now get two very talented coders and at very low cost build something that's purpose-built for you. And so I think if you're an incumbent and you're a horizontal application, you really need to think about how are you going to make your application either more relevant for specific industries or you're a system of record, which is Salesforce mode right now. All of the 250,000 companies in the Salesforce database are in a Salesforce database. And if that were not the case, my guess is we might not be using Salesforce. We might be using a system that's built for private equity, as an example. But the next point I'd make, vertical, on the other hand, has much less risk of disruption because the business process, if in the oil and gas industry or in a manufacturing industry, and you've built those business processes into your software and you're integrating into back-end systems and you're getting access to that data, that has less risk of disruption. And then the last point I'll make, so not to take up too much time, is that if you think about prior shifts, so when you went from client server to went from mainframe to client server or client server to SaaS, you were still just replacing software. You're taking one software and you're replacing it with a different software. Maybe you had a better delivery mechanism, you had updates that were more efficient, but now you're going after something different. You're going after labor cost as well. So the addressable market in a vertical software market is much, much larger when you're not just solving for software, but you're also solving for labor. So you're going in now and saying, Mr. LP, here's your portfolio risk management software. We're going to deliver it in the cloud. And oh, by the way, because it's AI native, there's 7 people you don't need anymore, right? And so the TAM for these vertical markets, whether you're an incumbent or not, is much larger because you're solving for a bigger cost play than you were historically.
Thanks, Devin. Richard, you have described AI as new flowers blooming on black soil, framing it as a core capability, not just a feature. Beyond providing capital, how do you see the private equity value creation playbook evolves in the AI era? Specifically, how are you helping portfolio companies to leverage AI?
Wow, that's a question for challenge for all the fund manager in the early stage VC, especially in the AI. So I think a lot of things still keep on changing. So how to create the value as the normal VC, but I do want to focus on what is AI bring difference compared with the other innovation cycle. Usually the innovation first come the science breakthrough, and gradually you move more focus on the engineering efforts. That will be the stage for the VC and the startup company focus on. But AI, for this, the innovation cycle, I think the key difference that, for example, like OpenAI or a lot of, foundation model company, the way they manage the innovation is that they consolidated the science or research plus the engineering. So that's very challenging for all those, the startup company and also for the VC, how to really identify the value and how to evaluate them. So that would be basically push us, how to give the question how we can relevance to the AI and capable to evaluate that, and also identify the good entrepreneur. So the way for us is that first, if we really want to be be relevant to this the innovation, we need to be more access to the science. The scientists or research, the networking. So that's very important. And also how to evaluate the SOTA of those, the company. We need to also bring some, the brand power from the outside. And also internally, we have to be more like, the research firm, not just the investment firm. So the knowledge management capability for all the VC and the PE firm is very crucial right now. So that's a lot of challenge for this industry. So our solution is that, just to very quickly adapt to this, the new paradigm shift, and also make networking and make friends with those, research. But also don't just follow the trap that, entrepreneur, there's so many, the entrepreneurs, they are science or the research background. That's the trap. If they don't have the engineering capability, the science or the research cannot convert to the real, the product. That's also the challenge for all the, sectors. So for us, how to, to create value, there's several things. I just mentioned those are the challenges, not for the VC, but also the entrepreneur. The other thing is that, any entrepreneur is older than 30 years, probably you are not, the AI native entrepreneur. So that means all the entrepreneurs in the AI native things, innovation, they're very young. You have to take the risk. So how to be neutralize or, the coach those young people, that's very challenging. Because, and also another thing is, the technology evolves so quickly. Every quarter there will be something new. So you have to identify those, the entrepreneurs who are fast learner, very quickly adapt. And the last thing I want to say, for AI, I don't think this is the internet in China. Innovation is more domestic, the demand. But right now, I think by nature, AI is global. So you have to identify entrepreneurs who have the global, the adaptivity as well. So that's a lot of things we can do, value add and value creation for ourselves, but also value added to the entrepreneur as well.
Thanks, Richard. So I should forget about a career in AI or starting my own company, staying at the HKMA. Today, AI and high valuation multiples go hand in hand. Devin, you have noted it's been exceptionally difficult to find interesting things to invest in because of valuation. I think you have made that comment before.
I might have made it to you yesterday.
Do you believe we are in an AI valuation bubble similar to the dot-com era? Or are there fundamental differences? How does this shape your current investment approach?
So I think absolutely we are seeing elements of a bubble in AI valuations. The challenge is, so one, let's first start by talking about what's a positive of a bubble. And unfortunately, it's not an investment comment. The positive of a bubble, and this is true in the telco industry, this is true in the internet, is companies are able to raise unlimited amounts of capital at very low cost of capital and build a lot of infrastructure. For the next 20 years, that's a good thing, right? Meaning we're going to have plenty of data center capacity. We're probably going to have, maybe we'll get creative about energy in ways that we historically have not been because the demand is needing to grow really fast. For a 20-year cycle, that's a great thing. And bubbles allow these bursts of investment to let you do that. So as a country, as a world, that's probably not a bad thing. As a fiduciary for HKMA's capital, it's not necessarily a good thing. So we need to understand the positives of that capital, but at the same time, mitigate the risk as an investor, right? And so how are we doing that? And I can only speak for ourselves. One, we're investing way slower than we were in 2021, right? So, we've raised a fund a year ago now, as you know, and we're only 25% invested. It would be very easy to be 75% invested. The second thing is other way we're risk mitigating is by writing smaller checks in very high growth companies where we can double down if it's working, right? Now the valuations for those companies are still high, but we're taking much smaller bets than we normally would and then really doubling down on the winners. And I think you do, to my earlier point, have to think about the addressable markets of these companies very differently, right? And that is a big difference from the prior boom. You also did have in the 99-2000 time period, many companies that were raising money that had no revenue. And while there's some examples of that, we were talking about that earlier, by and large, that's not true of the companies. And then the last point I'll make, what is true is these are unprecedented growth rates, but they're also unprecedented burn rates, right? So if you look at OpenAI, and I'm just using numbers that they've publicly disclosed, I think it's probably a $14 billion revenue company, but they've done $1.3 trillion of forward commitments basically to get capacity for compute, right? They've also forecasted $100 billion of revenues by 2027. The hard thing, and the question that somebody would ask me when you're underwriting is, well, what's the long-term margin? And I can't really answer that question right now. What is true is that the cost of buying AI tokens is going down dramatically. And what is that doing? It's dramatically increasing usage, right? To use a consumer analogy, we looked at Uber early on and we totally missed it. We missed it because we looked at it and we said, well, it's New York and San Francisco. It's a $300 million cab market. How can this ever be big? And they ended up doing UberX. What was that? It was just reducing the price point, making it more accessible, and demand significantly increased. So I think we're seeing the demand significantly increase. And then the question, which I don't have the answer to, is at what point is the value of what you can do so high that people are willing to pay a very, very large premium for it? We're not at that point yet, because the average ChatGPT user is a free user. Then you've got some subs that are $20 a month, and you got me at $200 a month. You don't have a lot of people above that, right? But if we can do some of the things that we think is possible in science and other areas over time, we should be able to, the company should be able to extract more value. But anyway, I think I answered your question as to how we're mitigating our risk with respect to insight.
Thank you. David, I saw you smiling and nodding. This is an important question. Do you have anything to add?
I agree. I would add one risk that people should consider is that many AI investments are actually quite correlated. It's really investing in the same thing, and meaning that many of the AI infrastructure plays, the data centers, the people developing the LLMs and the cloud providers and so forth are, many people have now pointed this out, they have a lot of company investment relationships, and they're all essentially relying on the same sort of growth that you were describing. And then there's another class of AI investments that are more, I'd say, in the application space, that are not part of that correlated bet on essentially infrastructure. And so I would worry more about the correlation issue here, and look more for things that are not part of that essentially same trade.
Thanks. So now we'll zoom out a little bit, and this one may get interesting. So David, I'll stay with you. We are seeing divergence in the global AI ecosystem, largely open source in China versus more closed source in the US. How does this difference in model accessibility shape the development of commercial use cases and business models?
Well, this is I think a very fundamental question for understanding the industry, and I can't really answer it, but I can point out perhaps ways to think about it. People that are making closed source systems like OpenAI have the advantage that they can essentially perfect the product, make improvements to it, and pass it on to everyone using it. And that's a very scalable approach, and they can apply vast amounts of money to perfecting the product and improving it. The open source models at the moment, don't have that advantage, and in benchmarking, they don't perform as well as, for example, the best that OpenAI has, although the gaps are surprisingly not necessarily as large as you might think. Now, this is still the early days. If you go forward 5 years from now, one possible scenario is that there will be a great equalization of ideas and technologies, and there won't be that much of a difference between sort of the open source stuff and the closed source stuff. In the software industry in general, if that's to be a trend, Linux is most people believe better for pretty much everything, which it's open source, than the closed source stuff that Microsoft has. And but in the earlier days, closed source computing, the IBM era and so forth, had better software. And so I tend to think that if you look at the way that the technology world has played out, open source has played a big role because it allows forms of collaboration that you wouldn't get if you have a closed ecosystem. Okay, so I don't know what the answer will be, but I wouldn't bet against open source. The other comment I'll make is that, and people do talk about this, if you're betting your entire business on a closed source solution provided by a company, what happens when they change it? That will impact the outcomes that you're getting from an LLM. So some people may feel that their business will have far more predictability. Once they have something that's perfected and working, they don't have to worry about it changing underneath them. Finally, I'll say that this is inevitable. Over probably a small number of years, all the ideas for LLMs are going to converge, as I said a moment ago. And then what comes next? People building specialized models that are tailored directly to their applications. One of the difficulties with the closed source approach is they're working on general solutions that everyone can use. And it's not really easy to come up with, at least with today's technology, an LLM that's good at everything. And so ultimately you may have a fragmentation where there are different models that are much more applicable to certain kinds of problems. I don't want to keep going here, but my final point will be AI is not just one thing. And one of the best scientific examples of AI is AlphaFold, the protein folding problem, and that is not an LLM. That's a purpose-built system using many different kind of AI components to solve the protein folding problem. I would expect to see more of these purpose-built systems for different applications in science and industry.
Thanks, David. Devin, you have something to add?
Yeah, I mean, I probably don't view the open source as a significant. I think the LLMs have significant risks in their business model. There's no doubt about that. I think we hit some of them. Open source is not keeping me up at night as a risk. I think that the few reasons for that, one, if you think about open source models versus open source software, really here what you're really doing is you're kind of opening your weights up, or kind of the underlying weights of the model. You don't really have a big community of people who are making tons of changes to the actual model. That's like number one. Number two, I don't think this is where companies wake up in the morning and feel like they have an edge. If you talk to Fortune 50, Fortune 500 CIOs, and you say to them, let me have a meeting with you, tell me how you tune an open source model to customize it for you. I mean, they're still trying to figure out how to implement AI. Tuning a model is way beyond what they're thinking about. And I believe that dependency, as Anthropic is already selling to 80% of the Fortune 500. So I'm not saying that open source is going to have no share, but I think there's a lot bigger risks for the LLM models than open source.
I think it's still, I agree with what you said. It's still the early days, though.
I was trying to disagree, but...
Yeah, no, but I agree, though. But I would only add to that it's still the early days. We're only a couple of years into this. And so when I'm looking out more, I don't think it's a risk tomorrow, but 5-10 years from now, I see a different kind of possibility of a different kind of convergence.
Richard, you want to say something?
Yeah, I think probably I have two comments. One is from the industry perspective, the other from China perspective. So for the industry perspective, I think normally, if you look back about the history of the computer industry, IBM used to be just advancing for the whole industry for many years, and it's typically the closed source, the model. And IBM claimed we only need 5 IBM machines. We can solve all the problems for the whole world. That's early days. But I think open source today have more like a thinking pattern like IBM. It makes a lot of sense because they are the most advanced, the model, and they can deliver everything for the full stack of and also the business model. They can generate revenue directly, and they sell premium. But I mean, always the computer industry, you always have the closed source and the open source. But open source usually means that much more booming of the application in all the the different diversified applications. So that's my one comment. The second comment from China's perspective, China always played the role that US is deliver the 0 to 1 most advanced breakthrough innovation. But China is the faster follow and more capable to transform from the breakthrough into the application more quickly and in more scale. I think at this time it's very similarly. You can see DeepSeek and other open source, the player from China. They play the same pattern. Like they can very quickly, deliver the similar performance of like the OpenAI, but with disruption, the innovation to deliver the much lower cost. So the open source, I think that's probably the smart way for Chinese company. If they cannot deliver the same advanced performance like peers in the US, the smart strategy, they can deliver the cost advantage, but with similar performance. So that's from the competition perspective.
The one other point I'd make, and David made the comment earlier on quantum as it relates to security, I think this is an issue with the open source models as well. These models are also much smaller. And as you kind of think about risks and threats of the wrong people using these models for wrong applications, that's just something that I think governments are spending a lot of time thinking about. That's not a comment about the investability of it. It's just something that I think we need to be cognizant of.
Yeah. Let me finish. The last point is that, in terms of the open source for China, is that, we have large population, 1.4 billion population. Usually means that you have more diversified use cases. And also it means that large data. And the closed source strategy that, OpenAI want to sell the token to you. But it will give you less capability to leverage your data. The open source, the approach will give more space for the developed community. They can leverage their proprietary data, and leverage that data create more value. So I don't think it's simple yes or no, it's good or bad. But I mean, this basically from China perspective, open source is a smart way to try to compete in this market.
I do want to ask one more question, but David, I'll let you have the last word on this.
I was just going to add that, as you can see, this is a hotly debated topic. I think it's actually a pretty key question as to how the models, the foundation models as it's called, evolve. And I think it is not a settled question. I think many people believe that, it's all been worked out. There are going to be a couple of companies that will have the very best models. Everyone's going to use them. That very well could be the case, but I think it is not anywhere near a settled question.
Thank you. So here's my last question. Tech giants are pouring unprecedented amount of capital into AI infrastructure. We are talking about trillions of capex over the next few years. And this is something our speakers also mentioned a lot about yesterday. Devin, from the perspective of return on investment, what is your view on this AI investment wave, and how do you guide your portfolio company on AI investments?
Yeah, look, so we're not investing at the infrastructure layer, right? So we're not investing in kind of the data centers or the things that have the high capital intensity. So the vast majority of our portfolios are not really spending money on CapEx. They're spending money on R&D to add to the application layer. But to the broader question, I think what we have is, if you look at the projections for the OpenAIs and the Anthropics, and they've publicly talked about numbers in the last couple of years, in the last couple of days, just between those two companies, they're projecting close to $200 billion of revenues 3 or 4 years out. So the interesting thing is that you could probably just from the revenue and gross margins of that revenue support the CapEx spend. However, at some point, you actually need a profit pool beyond being able to spend money on CapEx, right? And that's the question. And I don't know that I have the answer for that. Anthropic also said they're going to project significant profitability in 2028. I hope that's true. But I think that I do think there's a scenario. I think the question really is, how quickly can we absorb all this capacity? And the one thing we were talking about earlier, which we didn't really get into on this panel, but I'll just make the point that we all kind of talked about, is you're increasingly seeing these large companies do these data centers off balance sheet, right? Facebook, for example, just did off balance sheet. These are all AAA companies that can raise money at the lowest rates of any company in the country, but they're raising money at 9 and 10, 11% off balance sheet because they don't want them on their balance sheet, right? Why is that? Well, they don't want to have that leverage on their balance sheet. That's sometimes a sign that there's a risk to the amount of capacity that's being added and the speed at which is adding. So I think it's just something we have to continue to look at. You have to monitor the rate of growth. And if you see, I think what would stop this bubble, right? Like if all of a sudden Sam Altman came out tomorrow and said, oh, sorry, I didn't mean 100 billion, I meant 50 billion. That's where you'd worry, because that would just suggest that the rate of absorption of this data center capacity is not keeping, the revenue is not keeping up. Right now it is. And the last point I'll make, which was talked extensively about yesterday, and I'm not an expert on, but energy, right? Satya Nadella made the point 2 days ago that his problem right now is not accessing chips, right, which is really interesting if you're NVIDIA. It's that I can't get enough energy into my data centers to plug those chips in, right? So I think that what this is also going to drive is a massive, and I think this is a positive, I said earlier, a massive amount of innovation in energy. For the first time, the US is looking at nuclear again. It probably makes sense to have looked at nuclear, and it's amazing that it took ChatGPT to get the US back into nuclear energy. We'll end on that note. I'll end on that note, sorry.
David, you have anything to add on this one, or?
No, the real challenge, I think, in the next couple of years is going to be, right now I think we're in a period where everyone is experimenting with the technology in their businesses, and that's fantastic. The availability of technology to try things out is now quite widespread. So you can't find anyone who's going to say, I'm not testing AI at my business, and which is fantastic. And this is an incredible experiment. We're going to know better in a couple of years how well these experiments go. And I think that that is going to be something I'll be looking at really carefully. Are people truly getting productivity gains? Are they truly driving new innovation in their companies? Or is this something like PowerPoint? It's nice to have. It makes certain things look more beautiful, but fundamentally it didn't transform the business. This, to me, I think is the biggest question.
Well, I want to thank my panelists for the very lively discussions, and can we give them a round of applause, please? Thank you.
Wonderful job. Thank you so much. Of course, to our moderator as well. Gentlemen, if you'd step forward for a photo. We have our official photographer right down the middle. There we go. So if you can give one of your focus to the man in the middle there, and then right after he clears the path, then have a look at the RTHK booth in the back for the long shot. Thank you. All right. And I think they've captured the moment. Thank you very much, gentlemen. All right. Oh, is he still? All right. Well done, and thank you so much. Once again, big round of applause. Thank you to our panel. Private markets have become a huge part of the investment world, and it cannot be ignored. Often they have promised outsized returns, and sometimes they have delivered. Other times, not so much. But they cannot be ignored, and so now we are going to be looking at the short and medium-term strategies for approaching these markets. We're doing that with a heavy hitter panel that is going to be led by Stephanie Hoy. Stephanie is the head of private equity for Asia and the global co-head and co-chief investment officer for global growth equity with Goldman Sachs. She's going to be up here putting the hard questions to our panel, starting with Jeffrey Perlman, the CEO of Warburg Pincus. We have Jonathan Sokolov, who is the managing partner with Leonard Green and Partners. And finally, John Zito is the CEO with Apollo Management. It is a heavy hitter panel. Stephanie, you're ready to go. Let's get them up here, please.
Very honored to be here today with a heavy hitter panel. So I just want to make sure that you know the lay of the land as to who and what they do with the AUMs first, and then the focus, and then we'll go to have a very interactive discussion. So maybe I'll go from the other side first. So John Zito, Apollo, synonymous with credit. The AUM, by the way, I have to keep looking at the AUM because it keeps changing. So last week it was 860 billion. Last night, congratulations on the results, closer to 900 billion, approaching a trillion very quickly. And mostly credit, so that's the stage for you, for John. And then John, just to confuse you, there's another John on the panel here.
Jonathan, so it'll be easier to know.
Okay, Jonathan. We're going to go with Jonathan. So Jonathan is synonymous with the king of retail. All of you in the audience, if you had Shake Shack, that's him. If you have complaints, go to him. And $75 billion of AUM. Stay pure to the core. He is a U.S. investor, and retail being a part of it, but services increasingly very important to him. And we'll talk through what he's seeing in the trends there for the consumption. And then you have Jeff here. Jeff is more diversified, $100 billion of AUM, started as a core PE investor, so we have roots similar, but since diversified into real estate as well as to capital solutions, i.e. credit. Also, he had his roots, he's back home here, he was in Asia for many years, and so we'll talk a little bit more about what he's seeing in Asia as a trend. So with that as the lay of the land, we'll start with something a little bit warmer, easier first. So you have been traveling the world, and if you could be sharing with us key themes and top of minds for investors and corporations, and we'll make it short before we go into each of you for your focus. So with that, Jeff, I'll start with you.
Well, great. Thanks, Eddie and HKMA for hosting this great event. It's always great to be back in Hong Kong. Look, I've been doing a lot of travel around the world, and look, I'd make a couple observations. One, certainly coming out of Liberation Day, I think investors and allocators around the world have started to, I think, rethink a bit of their U.S. Exposure. It's not to say that it's going to somehow go from a hyper-exceptional level down to an average level, but I think a lot of folks are looking at bringing hyper-exceptional down to exceptional. And so think about it as maybe a 5 to 7% change in allocations. And I do think when they look at, do they steer that capital to Europe? Do they steer that capital to Asia? I think they look out, they see Asia with 50 to upwards of 2/3 of global growth over the next decade. And I think, the marginal dollar may end up more coming to Asia. So I think that's certainly one key area. We've heard enough probably over the last 2 days on AI, so I'll leave that one aside. But certainly it's the main topic of conversation across a lot of the meetings we've been having.
Great, thank you. Jonathan.
Thank you, and Eddie and the whole gang, thank you for having us all again in your beautiful city. So I, like Jeff, have been traveling around a much, but just to set the table a little bit. So 40 years ago, I moved to Los Angeles to join Mike Milken and Drexel Burnham and the junk bond crowd, really the birth of the private equity industry. And we had a fireside chat at our conference in the spring, and the title was Just Another Crisis. And as we look back over 35 years at Leonard Green and 40 years in the business, there's probably 10 or so major crises we've been through, and probably a third of the time we've been investing, we've been in a crisis of some type. Pandemic, war, 9/11, GFC, you name it. So for all of us, you have to keep that in mind. And it's easy to get negative and down on all the problems and all the crises, politically, geopolitically, militarily. So on this world tour that I've been on the past couple months, I was kind of uplifted by a lot of unifying forces that I saw out there that give me hope and optimism for business and for the world. I started in Riyadh, and Riyadh was having their comedy festival of American comics coming to Riyadh. Unthinkable, unimaginable just a few years ago. Then I went to Abu Dhabi. It was a Jewish holiday. I went to a synagogue. I went to services in a synagogue built and paid for by the government of Abu Dhabi, and that weekend was the NBA weekend. And then I went to Tokyo, and I went to a baseball game in Tokyo where the Tokyo Giants are playing. And then I went to Seoul, and there's an American artist having a big exhibit. And I went to Mexico City, and I went to Toronto. And everywhere I went, I did find just hope and optimism, and also tremendous entrepreneurship. There's a young group of folks, many in this room, that you're starting new things, you're doing exciting things, and in the end, we're a growth investor, and we just have to find growth. And there's so many good things happening in the world, in economies, that I think will overpower, the negativism and the conflicts and the tariffs and whatever else it is. So that was just kind of coming out of 2 months of kind of circling the globe, and I'm feeling excited and just empowered by what I've seen.
That's great. And Jonathan, so globalization is not dead. So good to know that.
Yeah, people want to be together. They want to work together. They want to share each other's musicians, sports, entertainers, hamburgers. I mean, Shake Shack is amazing. I mean, we have 50 businesses. We go into a meeting. Probably our smallest investment in the past many years is Shake Shack. And people love to talk about Shake Shack. We made a fortune on it, but it's did the world need another hamburger? But it's another unifying aspect. I mean, I was here when we opened
It's the ultimate unifier in my family. So
when we opened in the IFC and we displaced the Pure Gym restaurant when we were an investor in Pure Gym here at the time, and it was a crazy thing.
Great. So John, we're going to do something slightly different. We're going to weave your views of the world to you being a defender of the credit industry, because we heard earlier today from Katie, who's a former colleague of mine, saying that there's nervousness in the credit market. We also heard from Nicholas just now from Farallon saying that his restructuring business is actually it's 5-year high. So you, being the defender of the credit world, what are you seeing? What are you hearing? How do you feel about the world?
Well, first off, it sounds like I want to go on business trips with Jonathan. I mean, my business trips are definitely not as fun as that. But I guess that's the difference of the growth business and the value business. But I'm definitely changing my 26 plans pretty quickly.
You have to have some fun on all these trips.
I hear you. I think credit, again, the excitement about credit. I'll start just every meeting that I have. People ask, okay, what is happening in the broad markets? Why are equities at all-time highs? Why is gold at all-time highs? Why is Bitcoin at all-time highs? Let's forget the last couple days. Why is every asset class? Why are rates down? We don't understand. Why is it happening? And if I walked you through this backdrop, we're going to cut interest rates somewhere between 8 and 12 times. We're going to put probably the biggest deregulatory push into the financial system that we've seen in the last 15 years. We're going to allow for effectively all M&A to get approved. Companies that we've been looking at to actually get sold or do a transaction for the last 15 years that never would have been approved, all getting approved. And you add to that the single biggest platform shift in technology that's going to provide earnings. We can debate, and I see all the panels, everyone's debating who's going to be the winner and whether or not AI is real or not. The likely outcome is all of the, let's say, 3 to 4 trillion of CapEx is going to result in benefits to the consumer. And we'll see where the profit pool goes, but it will benefit somebody. It kind of makes sense that risk assets are up. It really is a market for this year, really a quantitative easing type market without quantitative easing, because it's all being done by different functions. And we had the little bit of tariff scare, but now that we've kind of moved past that and inflation seems to be somewhat in check, it's hard not to take risk in the market if you're a risk participant in any form. As for the defender of credit, I don't know if that's, we are a big credit participant. With the backdrop that the economy, broadly speaking, is doing fairly well. It's very hard to go into a recession when you have 40 trillion of book equity in U.S. homes. It's just functionally really difficult when you have that amount of asset value in the system that really has been untouched. The cohort of non-homeowner, non-asset owner, really the subprime, that's where you're seeing all the pressure. I expect you'll continue to see that pressure. We are concerned a bit about that cohort in the overall economy with all the pressures with fewer jobs, higher inflation potentially, and not experiencing any of the asset growth. That's a difficult position to be in, and it is something that is a bit more low on our screens. But as for the headlines, I have not. We really aren't seeing it in any of our portfolios. The one sector that is was the single biggest sector for LBOs and private credit was software from 2018 to 2022. I can promise you there wasn't AI in any of the risk factors in the 2018 memo for a enterprise software business. And so I had the interns last summer. I had them go through every conference call from 1997 to 1999 to get the quotes of every company that said the internet would be good for their business. And then I had them go to 2004 and 2005 and look at all the companies that said the internet would be good for my business that didn't exist anymore. And you have to laugh because every single management meeting and every single sponsor meeting I have, AI is going to be great for my business. AI is not going to be great for everybody's business. You have to move super quickly. You have to have a very flat organization, and you have to believe and move at a pace that is really hard for large organizations. And I think there's going to be a lot more dispersion amongst many businesses because of the new platform shift that's going on in technology.
Thank you, John. Let's just stay with you a little bit longer. So I'm hearing from you that there may be issues, but isolated pockets of issues in credit, but I'm putting words in your mouth, but you're okay with the credit side so far. Can you share with us, this whole discussion about duration mismatch? By the way, I started to have my eyebrow moved because you actually have insurance capital, and there was a discussion earlier on about insurance capital having a mismatch with credit. Can you just comment on that?
The retirement business and insurance business, as many of you know, has been a very large driver of Apollo's growth, but also the broad industry's growth in terms of just assets under management. And there's been lots of comments about the amount of risk in both private credit and on the balance sheets. When you look at the overall percentage of assets that are actually in the insurance industry, it's a very small percentage of the aggregate assets. And in fact, when you talk about ALM mismatching, maturity transformation is something that regulators talk about a lot. That's the ability to move a liability, the speed at which you can move that liability. A deposit, for example, is daily. A 10-year, any sort of 10-year liability is obviously long duration and typically non-callable. So when you move an asset from daily to long duration, typically that's safer for the system. And we've tried to be very cognizant of that. We were a really fast grower in the market. A lot of the incumbents didn't love us. We are now a very large part of that ecosystem. And when you're a big, large part of the ecosystem, comes a lot of responsibility. And we take that responsibility really seriously. And if you look at everything we're doing on the balance sheet, we're trying to run the balance sheet at really AA levels. When you compare us to any other balance sheet, and I'm not going to speak to the industry, I'm just going to speak to what we're doing. 70% of our assets are rated by the big three. We're really trying to be as conservative and actually in risk reduction mode over the last 12 months. So it is somewhat comical to hear some of the comments.
Great. Okay, we're going to go to the elephant in the room for anybody who is invested in PE. And that elephant is called DPI. Okay, so why no DPI? Is it a prevalent issue for all PE investors, or are you experiencing life very differently? Jeff?
I saw Eddie smile. He likes DPI, I know, as do many of our investors. And look, what I would say is what's unique about the last 3 years in private equity, and I think both would agree that the industry really doesn't have a good excuse as to why they shouldn't be delivering DPI, because unlike the previous periods where you had a material drop-off in distributions, it was tied into poor public market performance, right? It was right after the dot-com bubble burst. You had kind of 2 years after kind of the 9/11 period. You had 2 years kind of with the global financial crisis. Here, we've had kind of record public market performance. So from our side, I think part of the issue, I think you can point to a couple factors. One was obviously investors did way too much in the 21 vintage. They did 200, 300% more than their historical average. And obviously, they're trying to take as much time as possible to kind of grow into those valuations. And look, we always talk about real marks are demonstrated by actually selling. And if you sell, then obviously you've proven out the mark. So I think the 21 vintage is a huge issue, number one. Number two is investors forgot about the core principle of diversification. They went to very concentrated portfolios, either by geography, by sector, by stage of investment. And our experience, and I think one of the reasons why we've been able to distribute more than we've invested in 9 of the past 10 years, I think it's even true for 12 of the past 13 years, and I think has been reported publicly. We've had a record year of exits this year, and about 150% more distributed than invested since 2020, is because of being diversified, right? The ability to sell things that are uncorrelated, whether, this year, 8 exits in the first half of the year. You sold an energy transition business, an industrials business, 2 tech businesses, a financial services business in India. All these things are not necessarily correlated. And I think that's a big driver. The last piece I'll make and let others chime in is I think we're also in the sweet spot for exits. I think investors started to become too single-threaded as the investments became too large to an IPO. And I think as we talked and we heard some of the panelists yesterday, IPO markets are a bit structurally broken in that regard. And so we think of ourselves as one of the preeminent scaled middle market investors. Our average total enterprise value at entry is a little under $1 billion. And at exit, for those exits I mentioned, it was a little under $3 billion. Every financial sponsor can buy those types of businesses. Strategics can easily buy $2-3 billion businesses. It's very tough for them to buy $15-20 billion businesses. And then you end up single-threaded to IPOs. And obviously, we know the challenges in right-sizing the leverage from those large companies. So then they end up in continuation funds, which is not a great long-term trend if that's going to be some group's entire kind of form of their exit.
Yeah, so it's very interesting because you diversify and you go mid-market, so you are able to scale while doing those 2 things. I think that's very interesting. So Jonathan, I'm coming to you on how are you exiting your positions?
Well, I think DPI is correctly the most important area in our industry. I was at an ILPA, a small conference ILPA had in April, and the 3 major topics were DPI, the accuracy or inaccuracy of quarterly marks for PE firms, and the meteoric rise of continuation funds. Now, those are all linked, and they all are linked to DPI and the health of your portfolio. So what does DPI mean? Well, first and foremost, it means we send you money. So you like that, and that's what you need for your pacing model to work and the private equity flywheel to fly. But it's really a validation and confirmation that a PE firm is doing their job. They're investing in a business, they're growing that company, and someone else wants to buy that company from them at a fair price, which is then at or above their mark. So if a company comes to you, a PE firm, and says, our companies are great and our marks are really conservative and DPI is a little bit low, but everyone's is, and just be patient, give us another 3 years. That may be true, but it may not be true. It may be that they haven't done their job and their company has not hit plan and it's overmarked. So let's assume we go to sell a company and a PE firm goes to sell their company and they have it marked at 100. And they have a process, and the bids come in at 85 or 90. So what's the PE firm going to do? And if at $100 to sell it, that's a 5-year, 20% IRR. Well, they can sell it at 85 and take a write down, forget it. They can not sell it and reduce their mark to 85 to reflect the market. Never happens. Or they can just not transact, and they can wait. Always happens. So if they have a good company, and they sell it in a year at 100, and they wait, they keep their mark, the IRR goes to 17. In 2 years, 14, 3 years, 11. So in 3 years, the IRR falls in half. There's a lot of that going on because a lot of companies are mismarked. We still have tremendous discretion in where we mark our companies every quarter. Now, we know LPs don't want low marks. People don't want bad news. But there are a lot of mismarked companies. And as Jeff said, the only real validation that your marks are valid is when you sell. And have you sold at your marks or above your marks? So we all have these numbers we spew out. Our average sale is 20% above our marks. When I went to this ILPA conference, they said our industry is supposed to return 20% of NAV per year. That's how the industry stays healthy. and Bain Consulting yelled at us and said we're not doing our job. We're only running at about half that amount at 10 or 11%. Bad. So we've returned, on average, 20% for the past 5 years. What not only means we're doing our job, that our marks and our posted returns are accurate. And our returns are, by the way, have not kept pace with the public stock markets. Nobody has, but we think they're accurate. And if you haven't had DPI, it may mean both your marks and your returns are not accurate.
So the only thing I would just add to the other scenario would be, instead of just holding, is one of the areas that I think a few of us play in is capital solutions, which is then folks trying to take that type of capital, which is obviously more expensive capital, to kick the can down the road and preserve the mark on the valuation. It's been a great place for us to put capital because on a relative risk return, it's great for the groups like ourselves who are providing that capital, but it is pushing and kicking the can down the road.
Well, and we talked about continuation vehicles, which was the third subject at ILPA, and basically it's a very imperfect, challenged model full of conflicts of interest, and we're thrilled we have it. We're thrilled we have it as a tool in our toolkit to help get exits in a challenged market. Generally, you're kind of selling some good stuff cheap. And we thought that was such an interesting development that we decided to raise a continuation fund to be on the buy side. So we have a fund now to invest in the CVs of middle market PE firms where we think they're selling their best companies cheap. We want to be on the buy side of that trade, not the sell side.
So very interesting. I think what Jonathan, you're basically insinuating you have no issues on DPI because you're marking your books correctly, and there's a real market for that at this moment. And there are a lot of regulators in the room, so that will pique interest.
We have plenty of issues.
Yes.
Nothing's perfect, but directionally, if you're doing your job, these are results you should be getting.
Okay, great.
To that point, I mean, you should turn over your inventory every 4 to 5 years. That's the industry. That's what it's supposed to be, and I think not enough are doing it.
Great. So I'm going to go to John. John, in your career, in your day job, you basically pick also the right GPs who know what they're doing, and you back them with the credit on some of these purchases. So there are many GPs out there. These two are the top performers in the industry. So can you share with us the good GPs, like what are the trends you're seeing when you actually give them credit?
Yeah, I mean, these guys are being pretty modest. I mean, there's what Joe, what do you say, 19,000 PE firms out there. The by and large, we cover, I think, close to 700, but most of our financing happens to the top 75, and most of them happen with firms that you can trust and have been with for really long periods of time. And these two guys are being, again, pretty modest, but they've been doing it for a long time. And by and large, if you play games with the things that's being commented here, over time you'll lose trust with both your lenders and your investors. And I think over time it will be fixed, but it's probably taken longer than some of us would have liked. I do find it funny in the markets when a company can't go public, so then now they just sell to the CV market, which is just something I never thought I'd see in the market. And you have now not just single asset CVs, you have multi-asset CVs. And so what you're going to see in the industry is all this evolution, and it's happened in the credit business where, when we started in the credit business, private credit was lending to 3 or 4 car washes in some small town. We'd roll up the car washes and we make a $50 million, $75 million loan and grow the business and partner with the sponsor for several years. And now private credit is an $11 billion loan to Intel. So the world has definitely changed in the credit business, and the equity business is changing. And the equity business, the opportunities to exit will change. The evolution of new evergreen products for equity will change, and at the core, the people who actually can invest the money well will be able to sell it to lots of different buyers. There's going to be lots of different buyers that you didn't think would be traditional buyers of private assets, and that's the big thematic that's happening. It's happening a little bit slower in equity, but it's going to happen. And most of these assets over time, I think, will end up being much more liquid than historically was perceived.
We have a very good car wash chain. So
now it's like 200 car washes, so it's like different.
We'll make sure we show it to you.
Okay, I have a few topics to cover, and I only have 2.5 minutes, so I'm going to be aggressive here, and we'll do rapid fire, but like pretty deep topics here. Okay, Jeff, China, Asia, go.
Wow. No, look, Asia for us, we've been in Asia for 30 years. We'll just celebrate our 30th anniversary in India next year. As I said, we think it's one of the cheapest places to invest in the world right now. I think China, the challenge for the previous few years was that the valuations hadn't reset. Now that they've reset, on a relative basis, it's getting quite attractive. I mean, you can buy businesses that are growing at 20% a year that you can all of a sudden buy for 5 or 6 times, EBITDA. The question is how long is it going to stay, like that? And so I think, so many of our peers have kind of pulled away both from China and from Asia. But I think as you look out, I think it's going to continue to be an interesting opportunity. And you take a market like India, the flywheel's working so well between the public market, both new issuance, the ability to sell down, the interest level from strategics, and obviously more private equity capital going in. So we just think that flywheel produces scaled investment opportunities. You can invest in more control now that you couldn't, 5, even 10 years ago. And again, you can come in and you can get out. And I think that's why I think India is going to continue to draw a lot of capital going forward.
Great, wonderful. Jonathan, company building, what is your secret sauce in 30 seconds?
Look, our job is to find a company that we have high conviction that we can double, triple, or quadruple over the course of our ownership. And we view ourselves as growth accelerators. Are there 2 or 3 fundamental changes we can maybe make to their business model to make them grow faster, whether it's organic growth, whether it's an M&A, whether it's tech-enabling old economy businesses. And look, the first rule of any investment committee member at Leonard Green is why we won't lose money. We come from Drexel. We saw all the junk bonds. We went bankrupt. It was pretty ugly. So that's our first rule. And the second is, can the business go backwards? What could happen to really mess up the business? And this is the skill we've developed over 35 years. And if we double, triple, quadruple EBITDA, no matter what crisis comes, no matter what the stock market is or interest rates are, we will make money. We may not make as much money if multiples come down or this and that, but we'll still make money. So you must have conviction and be able to grow these businesses.
Great. Wonderful. And John, you have the last word here. How do you manage $900 billion and still maintain quality?
The paradox of scale and artistry is one that's really hard. And I grew up in the small markets business, running a small hedge fund, and now I oversee. And I promised myself I would never be the $900 billion provider of capital, and didn't think that would ever become actually an outcome. So it's been a fun journey. The 60% of our balance sheet's investment grade. Our opportunistic business, our private equity business still has not actually grown in size. Our hybrid businesses, our opportunistic businesses in general, kind of up and down the capital structure, have still stayed somewhat inside. Most of the growth have happened in the BBB single A part of our business. And so that part of the business is all about origination and finding different asset classes that have super stable cash flows. And the alpha construct is a different construct. It's about earning an extra 100 basis points, 150 basis points, not earning 18% absolute rates of return. And when you think and you frame it that way, it's much more manageable, and it allows me to sleep at night and still perceive ourselves as great investors, which I think at our core we've always been, and remain committed to that. So we're pretty excited about continuing to grow, but mostly in the performing credit part of the business.
Well, thank you very much. A lot of wisdom, a lot of materials, and we look forward to the next panel. But thank you for your time.
Magnificent job, Stephanie. If you could, please step forward for a photo. And there we go. Great looking panel here today. Thank you very much, Stephanie, Jeffrey, Jonathan, and John Zito, the co-president of Apollo Management. And look to the back of the room for the RTHK shot. Just one tall man? There we go. All right, thank you very much. Once again, big thanks to our panel. All right, gentlemen, we are moving on. Stephanie, give them a little prod. Fantastic. You heard me say it before, and I will say it again. Hong Kong is one of the big three among financial capitals in the world, and we are anchored here in Asia. And so now we turn our eye to Asia. Some of the smartest money I know is very bullish on China right now. You just heard a little bit of it there. But there are also opportunities in ASEAN and some of the major economies like Japan. Our next panel has that ability to give us the 30,000-foot view and then zoom right into the micro level to let us know about opportunities in this part of the world. So we're going to be excited to have them up here. You could call them Enoch and the three chairs. Enoch is the Enoch Fung, the CEO of the Hong Kong Academy of Finance, is going to be joined up here on stage today by Fred Hu. Fred is the founder, chairman, and CEO at Primavera Capital. We also welcome a Hong Konger, Jean-Eric Salada, who is the chairman at EQT, and as well, Tang Lei, who is the founder and chairman at Hill House Investments. Enoch, the floor is yours. Let's hear about Asia.
Thank you very much, Andrew. And ladies and gentlemen, a very warm welcome to our final panel. And let me just tell you for sure that we are saving the best for last. Now, throughout this morning and also in the afternoon, we've actually explored now multiple themes about different asset classes. Today, as Andrew mentioned, we are actually going to delve deeper into Asia. Now, before I start all that, I should mention, as I said, this is pretty much a star lineup. They're all founders of their own investment houses, the three of the most influential investment houses in Asia. So we're going to get a lot of wisdom from these speakers today. So this morning, we've done rapid fire questions. We have also done Ask AI questions. I'm going to combine two and do one quick fire Ask AI question. So my rapid Ask AI question is this. I asked DeepSeek, what would be the most market-moving event in 2026 in one word? DeepSeek came back with cyber attack. All right, so I'm going to ask these gentlemen here, so starting with you, Fred, what would you be the one word for shocking the market next year?
Mimic DeepSeek. Let him think. R1, R2, R3. Energy.
Energy. All right.
I would go with AI, the impact of AI on businesses.
Okay, so AI.
I would say one word to the deliver. We have talked too much. They need to deliver.
That's a good reminder of this panel, actually. So we will move on. Now, as I mentioned, you are founders of your own investment houses, and you are definitely very well reputable across the world as well. Of course, you have got significant operations in Hong Kong. Could you share with us how you actually make use of Hong Kong, your Hong Kong operations in delivering the businesses, servicing your clients, and also what you like about Hong Kong in general? Yeah, Fred, I'll start with you again, and then, yeah.
So last 4 weeks, I've been to 20 cities across the globe. But Hong Kong is my home. So I could have been in any of those 24 cities, but Hong Kong is my home.
So, home, okay. Sean?
Well, I've lived in Hong Kong for 36 years. I arrived in Hong Kong in 1989, and I've lived here ever since. And I love Hong Kong. I think Hong Kong is a wonderful place to live and also to do business. And it's where we started our business and where we're now headquartered, not just for Asia, but in my new role as next year I've been nominated to chair EQT globally. I'll still be based in Hong Kong for that. So one of the few global private equity firms that actually has a chairman in Hong Kong. I think Hong Kong, to me, Lei's going to probably mention that we like to go wake surfing. That's one of the things that's beautiful about Hong Kong is that in addition to being a great place to work hard, but you can also, within 15 minutes, you can be on the water or you can be on the trails, as we heard in the HKMA summit. So I think in terms of balance, life balance, work-life balance is fantastic.
Yeah. I would add to that because one claim to the fame for me is to actually teach Zhang to wake surf in Hong Kong. but
still learning, but
no, students better than teachers. I think one thing hugely underestimated is how, because every time we have conference and meetings in the central, actually just 15, 20 minutes away, you are in the water. And John and I were talking about this. We highlight 4 trails. Next year, the conference, let's highlight the Hong Kong water.
Okay. Yeah, please, Frank.
So I'm not as risk-taking.
John got to contribute his wake surfing video to the...
Yeah, I'm not as wild as these two guys, but I love Hong Kong. I enjoy outdoor and hiking, and for really the merit of Hong Kong, I just think for me is very simple. Hong Kong is the best of both worlds. It's quintessentially Chinese, but it's also quintessentially international. There's no place on the planet like Hong Kong.
I once bumped into Fred and Big Wave Bay hiking down from the mountains with a few people, and they had run out of water from their hike. They've been hiking for 4 hours. Fortunately,
thank you for saving me.
Yeah, we were there. I was there with my family on the beach. I gave them a couple bottles of water, and they carried on.
Just so you know, at the pre-meeting, when we were just trying to plan for this, they decided that they're just going to talk amongst themselves in front of you. So I'm happy with that as a moderator. But okay, let's just get to a bit more serious stuff. If I may, Fred, I could start with you. I wanted to get your thoughts on the role of capital markets in China's economic transformation going forward. Now, I want to start off with something that take you down the memory lane. So I used to work together quite closely with you more than 20 years ago. You were a leading market economist on China for Goldman Sachs. Back then in 2001, you published a report titled Das Kapital, Capital Markets Are Transforming China. So that report basically outlined with incredible foresight the role of China's capital market reforms and also its opening up to foreign investors. Which also happened to be a great business plan, very profitable business plan for Goldman's investment banking business back then. But it is really important to see how the capital market is supporting the real economy throughout the last 20-something years. So looking forward, with all the economic transformation going on or planning to do, particularly under the 15 National 5-year plan, what do you think the role of the capital market is for China's economic transformation going forward? Now, I take it that probably in the last few years we've had the Western media kind of imposing some skepticism, if you like, about the policymakers' resolve in the capital market reforms. But we've heard yesterday from the policymakers at the summit that they are very determined in pushing and promoting the market reforms. So what's your take on that?
Well, first of all, I'm amazed, Enoch, you could still remember the research paper published 25 years ago. Awesome. So as you can tell by the title of the report is Das Kapital in German from Karl Marx. That itself reminds us, this room, investors, that the stock market is the most capitalist of all institutions. And the Chinese leadership, despite all the ideological biases about China, was enthusiastically pushed through capital market development. So 25 years ago, Chinese stock market was emerging, ranking number 8 globally behind each of the G7 countries. 500 billion in total market capitalization, of which maybe 10-20% were free float. So it's really, really insignificant in the global capital markets. And today, Tencent alone is much bigger than the entire market cap of China back 25 years ago. So now, China is second largest after the US, bigger than any other G7 countries except the US. But the good exciting sense, there's still so much potential lying ahead in terms of market cap, GDP, US is over 200%. That's why, US has a stock market that's over 60 trillion, where China is about 15 trillion. So let's say, this is actually, by the way, Warren Buffett's favorite metric. China is cheap. Okay, there's a far more upside in coming years. Number of companies, actually, there are more populous companies in China than in the US. 5,000 versus 4,000. But again, since the diversity, stock selection, Lei and is expert, that across so many industries, you want a good, diverse equity portfolio. And the bond market the same, 30 trillion, second only to the US. So huge potential ahead, and capital markets are definitely going to transform China and ensure sustainable economic growth. Also empower Chinese middle class to have retirement savings and wealth effect to spend. So make Chinese economy much more sustainable over mid and long term.
Thank you, Fred. So can I move on to Sean? I wonder if you can reconcile something that, building on Fred's comment, something a bit more contradictory, which is that you're looking at the data on the capital raise for China-focused PE funds and VC funds. They've actually slowed quite a bit in recent years because of maybe slower headline growth, the more sort of uncertain macro environment. So as I said, how do you reconcile that? What do you see as the current state of the PE and VC ecosystem in China? And what sort of catalysts are you looking for in kind of seeing a recovery in that market?
Yeah, I'm actually bullish on China, and I'm actually very bullish on Hong Kong as a result of what's going on in China. If you look at the 15th five-year plan that's just come out, the points that are emphasized there, innovative manufacturing, investment in technology and AI, supporting the consumption, the shift to consumption. And the fourth one is really the capital flows in and out of the country and encouraging more foreign investment and opening up of services. That's really going to benefit Hong Kong. And as I look at what's been happening in China, we've been through a difficult period with sentiment and with a cyclical downturn. But I was just in Beijing last week, actually, for a few days, and what you're seeing on the ground in terms of innovation is just mind-blowing. The kinds of the factories that you're seeing and the way they're using robotics in manufacturing. I went to see Xiaomi's electric vehicle factory, which is extremely impressive. If you haven't seen it, very few people there, a lot of robots. And if you talk about what's happening in private equity and venture capital, I would say that the private equity market is developing in China. So it's the buyout market, I'd say, is relatively immature in China, but it's starting to develop. But I think what's really interesting in China at the moment is the sort of the growth capital and the venture capital market with the innovation and the kind of highly innovative companies that you're seeing. And then, of course, the role that Hong Kong is playing for exit and liquidity, which I think has been one of the big challenges for the industry. That's also really opening up now with what's happened in the last 12 months in Hong Kong, with the stock market really coming back to life and global investors starting to reallocate. And just to echo what was said earlier in one of the panels on the kind of rebalancing that we're seeing in the world, we see that as well. A lot of clients that we talk to, particularly non-US clients that we have in our business, they feel like they're over-allocated to dollar assets. They're looking at diversification, and they're looking at ways to rebalance their portfolio. And one of the big beneficiaries of that, I think, is going to be Asia, and is going to be Hong Kong and China.
Okay, next up, thank you, Sean. Next up, I wanted to talk to Zhang Zong because there's this quote-unquote global AI race going on, right? It's quote-unquote, okay? So we can debate that. But the DeepSeek moment earlier this year basically marked maybe a turning point in China's overall AI narrative, highlighting not only rapid model development is important, but also a growing ecosystem of homegrown innovation and also scalable infrastructure. So in your view, Lei, what is actually China's niche in AI?
First of all, I'm not sure this AI race is the right characterization, because I really believe this is not a zero-sum game. It's if you believe this is sort of the electrification, industrialization moments of humanity, then that's going to benefit humanity at large. And China, rightly or wrongly, just take a different model from the US, which mostly characterized by high power, high capex, closed loop, high monetization model, where China is doing a very much a low cost open source model. We can debate on the models, forever. I don't have any insights specifically on large language foundational models when I'm investing in models. What we are really seeing is, earlier, your first question, I said the word deliver, which I happen to believe that China gonna be probably the first to deliver much more on the application layers. That's what we saw in mobile internet when the apps, coming out from Messenger and WhatsApp, ICQ, and turn out to be WeChat is much, much better super app than any other apps that you are seeing in the mobile world. And similarly, you saw that in the financial services, Alipay and WeChat Pay and Meituan on delivery and Xiaohongshu on the social, and you're seeing way more application layers innovation. If you look deeper in that delivery, let's just use this word for now, that delivery mechanism, you see some logic behind it. Just that quick, fast iterations, R&D engineering dividends, massive use case, readily huge consumer markets that people want to embrace new technology and don't mind trying new things, and a low cost model of doing that. And I think it's we might well see a lot more in the next stage of application layers that China and broadly Asia gonna be a big innovator in that.
Yeah. Can I add on? So in earlier first question, I didn't say AI because I anticipate, maybe John and Lei are going to say AI. I mentioned energy. So right now, I think there's a race, but unlike people in Washington, the race is still ongoing. Right? It's like a marathon, not a sprint. I don't know who will end up in the finish line, and I think I don't want to be dismissive of U.S. leadership in AI, but I very, very, very confident China will be a leader in the AI revolution as well. So AI is quintessentially linked with up to data, with the human talent engineers, and with electricity, right? Compute power. It's not just compute, but also power. So China has the world's most advanced and the largest electricity power infrastructure. So the country generates 3.7 terawatt. Okay, that's more than 3 times as big as the US. And in fact, every year, China grow the grid capacity by around 18%. US now, there's been a lot of investment into power infrastructure, since 2023, 2024, but it's about 3 to 5% annual growth. So I think this alone would also show, China has tremendous promise in AI revolution.
Okay, moving on to the rest of the region. Thank you. That's very insightful. I wanted to maybe go back to Jean about Japan. There's been quite a bit of interest there, probably because of deregulation and the corporate governance reforms and everything. You're doing quite a bit on that. Can you share with us your insights?
Yeah, I think Japan it's a deregulation and corporate governance story. So 2019, they passed a law called the Fair M&A Guidelines. And in 2023, they passed another set of guidelines called the corporate takeover guidelines. And essentially, the first one was about the need for public companies to establish a special committee if they receive an offer from an outside investor. And the second one kind of took it further and made it a kind of a fiduciary duty of directors of the board to take into account shareholder value primarily over the interests of the board members and the management team, which historically that's not been the case. And so the combination of these big regulatory changes has led to, and they really stuck with it and backed it with a lot of other enforcement measures, has basically led to a surge in shareholder activism in Japan. You now have over 100 shareholder activist funds in Japan. And what these guys do is they come in and they take a 5 or 10% stake in a listed company, and then they agitate for change. And so they are causing a real upheaval in the corporate environment in Japan. And there's also kind of a mindset shift now that's backed by the government, which is that you now, if you're a publicly traded company, or if you're a corporate generally in Japan, you need to take shareholder interests into account, and you need to focus on your core business, and you need to figure out how you drive value in your business. So this has resulted in a huge surge in deal flow and a huge surge in private equity activity. And so it's now, I think, a $40 or $50 billion M&A PE market. This year alone, it's already $40 billion of investment in Japan, up sort of 50% year on year. And for us, it's become actually our most active market in the region. We've just signed a $2.7 billion take private of a large elevator company in Japan called Fujitec Elevators. And we're just seeing more and more activity like this. And historically, generally in Japan, you've been able to make good money on investments because there's a lot of undermanaged assets. There's a lot of sort of inefficiency that's in the system. And once you get better governance, once you get an active management team in place, there's a lot you can do very quickly to drive value creation in the businesses.
Yeah, it's great insight. So Fred, for the rest of the region, particularly Southeast Asia, there's been sort of, the market is growing. China plus one has been kind of the main catalyst for driving interest, but access has been a problem, right? And also the market has been quite fragmented. Any thoughts on your side, Fred, on Southeast Asia or just rest of the region?
So, South Asia is tremendously promising economic growth and middle-class innovation and investment opportunities. But unlike China and unlike India, it's not a homogeneous market. It's quite fragmented, right? So I think the regional integration is really, really important. So you don't think of just individual markets. Oftentimes they are pretty small and has all the idiosyncratic risks in terms of regulation, law, and the business culture. But I think as ASEAN makes headways in free trade integration, and particularly for Chinese companies, actually they are the single biggest direct investor in ASEAN and also the biggest trading partner with the ASEAN. I think we go there with our portfolio companies. So they have on the ground, boots on the ground, they have operations there. So we help us understand the risks as well as the opportunities.
All right, thank you. That's very useful. Now, we still have about 5 minutes or so. I wanted to also hear your thoughts about running your businesses, because at the Hong Kong Academy of Finance, one key mandate is really promote leadership development. So I'm hoping to hear your thoughts about how you grow your leadership team. What are you looking for? Any particular initiatives that you put out with your firm that actually helps to promote leaders? And what was the result in helping or making an impact on your firm's performance? Zhang Zun, can I start with you?
Sure. Our culture, we always emphasize intellectual curiosity, intellectual honesty, and the teamwork, and typically exemplified in the financial institutions, professional service organizations. But what we found over the years, one of the best training grounds actually sending our promising, top-performing young employees and associates to work in our portfolio companies. Actually, they work inside portfolio companies for a couple of years and coming back. We found that is tremendously helpful to them and adds a lot of value in our own investment discussion. They just got into the nuts and bolts of running the businesses on a daily basis. A number of our partners actually now in the firm work in the portfolio companies and coming back, and they do really great job, and they have so much better understanding on the operation level. So I thought that would, now we almost like getting a bit more program, rotating people and getting people running different businesses.
Sean?
I think there's there's a difference in our industry between doing good deals and building an organization and building an institution or building a franchise. I think you have to make good investments and know how to be a good deal maker in order to stay in business. But in order to scale and to become a real franchise business, you need to develop an organization. And that's a slightly different skill set, and it's a slightly different emphasis that you need to put into your business. And that's something that we've really focused on over the years. And I'd say a few things that we've done that have worked well for us. One is to really promote from within, always promote from within, and to build a culture that is a sustainable culture within the organization. So if you look at our partnership, we have almost 20 partners in the firm now, just within Asia, and the average partner has been with us about 17 years. So it's that kind of culture of continuity, number one. Secondly, we do a lot of mentoring internally, where we assign a sort of a senior person to a very junior person, and I actually do one or two myself a year as well, where you just continue to sort of stay in touch, see how people are doing, help nurture the talent, and sort of help to grow the talent internally. So I think just emphasizing talent development is a really important part of our industry, and going forward, it's going to be even more important, because at the end of the day, coming back to the point that Lei mentioned about delivering and performance, which is what it's all about, and distributions, it boils down to the team, your talent, your capabilities as a firm. So investing in your capabilities and making those capabilities more repeatable boils down to how strong your team is and how much effort you're putting into that.
And one touching point is that you actually do the mentoring yourself to the juniors as well. Is that what you mentioned?
I do some. Yeah, all of the partners do, but I also get involved. I put actually a lot of emphasis into the year-end review process because I think it's really important.
How big is the team then? Are you, in terms of your operations?
We have 350 people across the region, of which about 180 are investment professionals. That's a big team.
All right. So this is how you manage, as you sort of look into their performance reviews and stuff.
We have a pretty automated internal review process where we have a very systematic way of doing the year-end reviews and setting objectives, and each of the partners, each of the managers would review people within their organization.
Great. Fred?
Yeah, so I agree with some of the great insights shared by Lei and John. So I do emphasize the importance of mentorship. That's reflecting my career at Goldman Sachs. I was fortunate to have great mentor like Hank Paulson and others. And I myself also served as a mentor for many of the upcoming leaders. I think that's really, really important for leadership development. Second, learning. Our industry is full of bright, ambitious people. But I also want to make sure people have a bit of humility. So they obviously know what they know, but they should also be self-aware of what they don't know. So if there's any gap, it's really learning, right? Lifelong learning. So even though you have all the basic degrees from the best university of Tsinghua or Yale or Harvard, you still have a lot you don't know, so you have to keep learning. So when I travel like crazy, but when I go to office, meet the people, senior people, the first question is, what book have you read, last couple of weeks, right? So then they'll share something, and actually, in fact, we have a book club, and some we even share in the WeChat public account, but mostly among ourselves. I think this lifelong learning, I think is also critical ingredient for leadership.
So great tips, secondment to portfolio companies, take care of the review process, you hands-on on that, and of course, as Fred said, the mentorship as well. So quite a lot of, and book clubs, sorry, I should mention. So thank you very much. Unfortunately, we have really run out of time. I would want to listen to them more, but I'm sure you all agree with me that they have definitely delivered. Again, thank you very much, gentlemen.
Thank you to Enoch and our three chairmen. If you gentlemen would come forward for a photo. There we go. Great panel. Great way to have our last panel today from our conversations with global investors. There we go. One right down the middle, gentlemen. And as soon as our official photographer is cleared, look up far away to the RTHK for the long shot. And there we go. Well done. Thank you very much. Enoch, you've done a great job. Great job, guys. Thank you. Thank you. Hey, that's great. Cheers. Thank you.
Thank you. Good job, man.
Wonderful. These have been amazing conversations with global investors right up here on stage, and we want to thank all of you for being here today, and especially our speakers who have shed light, cleared away some of that fog of war that we spoke us, and given us some more visibility on our long-term strategies and the path forward. To close, we would like to welcome to the stage the man who has brought us all here together. He is the Chief Executive of the Hong Kong Monetary Authority and the Chairman of the Hong Kong Academy of Finance. Please welcome Eddie Yu. Eddie, please. Take it away, Eddie.
I will be extremely brief. I would just thank all our speakers for the really open, candid, and educational sharing this morning. I myself learned a lot from it, and I hope that you did as well. I would just like to also thank all of you for staying beyond lunch hour to stay here and enjoy the conversations. And as I said, we started off with a one-off event, but I'm really glad that with the support of all our speakers, all the CEOs, and all of you, we keep going year after year after year, and we will continue if you continue to come. And next year, just to get everybody ready, we've already set the date. The summit will be between the 2nd and 4th of November, with the dinner on the 2nd, the summit on the 3rd, and the conversations on the 4th. So mark your diary and come back. And for those who came from overseas, I hope you have a safe flight home. Thank you very much, everyone.
Thank you very much, Eddie. Thank you to all of you for coming. And remember, Hong Kong is still as vital and exciting as ever. We welcome you here to make the future happen, today, tomorrow, and forever. I'm Andrew Work. Go forth and prosper. Thank you.